This cycle is being defined not by its severity, but by its duration.
Higher global interest rates, lower equity prices, and a stronger dollar, we think will continue into year-end.
I just think the stock market's washed out.
I think that 3,200 mark, if 35 doesn't hold, I think 3,200 is the next natural place to go.
I get it that we're probably not at the bottom, and there's more stress to come, but things are starting to look pretty reasonable if you can take a longer time horizon.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio. Alongside Tom Keene and Lisa Abramowicz, I'm Jonathan Ferro. Futures up and away again on the S&P 500, up by 1.29%. TK Goldman coming up a little bit later.
Yeah, Goldman coming up a little later. It's going to be interesting after the generally good news we saw. But, John, it's finally a quieter tape. Yeah, lift in equities and that. And you say, why? And I'm going to one person, B. Moynihan. And that is the comfort here. And you wonder, do we get the same surprise from a beleaguered Solomon like Moynihan? He's going to say, I'm sorry, business isn't all that bad.
Let's sit on Bank of America and talk about the other consumer banks as well, Tom. So Brian Moynihan of Bank of America coming out and saying consumers are spending. They have money, they're employed, they have good credit. That was echoed by Jamie Dimon of JP Morgan as well. Consumers are in very good shape. We had Jane Fraser over at Citi. The US economy remains relatively resilient. We know all those things about the US economy in the third quarter. Can you say those same things in about 6 to 9 months' time?
No, that's always a worry. And it goes to the conference calls and this dreaded forward guidance in the corporate space. Gina Martin Adams is really good at this at Bloomberg Intelligence, and she says, yes, there's a weight to looking out further now like there wasn't a year ago.
Early days in earnings season, Bramo, but are we skipping over a very low bar for the third quarter?
A lot of people say that, and we're not even skipping over that much. And when you don't skip over it, you get punished pretty badly. It's hard to come away with any kind of conclusive narrative with some of the trading activity, especially when you have Bank of America reports talking about embrace the bear, but prepare for the bull, and all of these sort of, metaphors that are what is it? How to be a more comfortable bear. Embrace the bear, but don't get kicked by the bull.
Therapy.
This is therapy for people who are looking at a rally that's going to rip their faces off because it doesn't make any sense, but it's the meantime.
Are we all vulnerable this morning?
I think so, a little bit.
I feel so vulnerable. Okay, give me some more tang. Okay,
this sounds like Southside therapy. I sat there on Friday doing Bloomberg Real Yield, and I turned around to the guests and I said, I feel like this should be just a 30-minute show of market therapy.
It's about losses.
To get through the week.
Let's just do this. The bear market down 15%, down 18%. The bond market, I'm sorry, as we open the show today, it's a quieter day. We need to look at -20, -30. I looked at one ETF bond fund down 34%. John, that's a bear market, and that's where you need therapy.
I've heard a lot about scope for a bear market rally. We heard that from Hartnett over at BFA this morning. No cuts, no glory is what he has to say, though. Ultimately, you've got the ingredients, perhaps a recipe to get a bear market rally, but the lows for the team at BFA in that fund manager survey, not until the first half of next year.
And it's exactly because of what you just said. It's not about jumping over a low bar for this earnings season. It's about what happens next. And what's the guidance going to really give us if you have no guidance into next week? Other than, evidently, Mike Wilson, he has a crystal ball. Nobody else seems to.
He seems to have some insight nobody else has, TK. Mike Wilson over at Morgan Stanley. It's kind of unreal.
And what's great about a guy like Mike Wilson, and there's many others we talk to every day, folks, is they have a humility about it. Mike Wilson knows he's going to get it wrong at some point, and he has that earned. Would you like to speak?
Talking about earned humility. Marco, did you see him capitulate?
He trimmed. I don't know if that's capitulation in Marco's world. I'm not sure that he'd appreciate that particular phrase.
Well, I'm just saying. I mean, he kind of walked back some of the risk appetite that he had.
Trimmed his overweight on equities. It's still overweight.
All right, fine, fair.
When he goes underweight on stocks, then we'll make the change. We'll talk about the gilt market in the Financial Times a little bit later as well.
I know you're guilty too.
Super excited about that too. Let's whip through the price action for you. On the S&P 500, we are positive by 1.3%. Elevated in the equity market on the S&P, pushing higher once again. In the FX market, look out below cable. Cable breaking lower by 0.8%, 112.70. So the FT comes out this morning, Tom, and says the Bank of England is getting ready to delay the start of QT. Yes. Then the Bank of England comes out and says that report is inaccurate.
They're making it up as they go. I thought it was as a complete amateur on this, I thought it was a difficult day for the Prime Minister yesterday. It was really her toughest.
You thought yesterday was difficult?
Of all the different days, yesterday was just difficult. The other thing I noticed in the data, and finally, folks, a fairly quiet day, is dollar yen. I was surprised. It's a solid 149 here.
Getting closer, eh?
It's something here to watch. That's all there is to it.
Yields right now on a 10-year as well, just to round this out for you. Pretty much unchanged, up almost a basis point to just north of 4%. Bramo, some big moves in this market the last couple of days.
Yeah, how much are earnings really going to feed into that? You talked about Goldman Sachs earnings coming out at 7:30 a.m. today. The last of the big banks to come out. How much is that really indicative of what we're going to see from the rest of the earnings complex, the rest of corporate America? Netflix after the bell, United Airlines and J.B. Hunt, some of the other names. It really starts to kick off and broaden in terms of scope of the companies that are reporting earnings. I am particularly interested to see the post-COVID darlings that have lost their luster, like Netflix. United Air, I'm very interested in because air travel has continued to take off despite the fact that tickets are just so expensive and people still seem to buy them. Today, economic data includes U.S. industrial production out at 9:15 a.m. and NAHB housing market index data at 10 a.m. And Tom, how much is home builder sentiment deteriorating? It's expected to go to the lowest going back to 2012. How much does this really lead to what you're worried about, which is some sort of housing crisis?
Well, yeah, I don't know if it's a housing crisis. It's just going to be an adjustment, the mother of all adjustments here with mortgage rates. They're 7%.
The mother of all adjustments, a crisis, you know, tomato, tomato. And also today, Fed Speak includes Atlanta Fed President Raphael Bostic at 2 p.m., Minneapolis Fed President Neil Kashkari at 5:30 p.m. What do they say about front loading? We have heard this, you know, Jim Bullard talking about possibly raising rates to 4.75% by the end of this year. Is this the goal, to raise it to that kind of level and keep it there and pause there and try to get ahead of it? Or is gradual more of the theme? And I think that that's going to matter, John, in terms of the risk appetite and what people see going forward for the Fed and rates.
Hey, Lisa, thank you. Let's talk about the rate market. We can talk about QT and let's talk about sterling. We'll do that with Kit Jukes, Chief FX Strategist at SocGen. Kit, help me out here. So when I report that QT gets delayed, sterling climbs to session highs through 114. On the pushback from the Bank of England, sterling falls to session lows. Kit, am I to believe that QT is somehow sterling negative and delaying QT is somehow sterling positive? Based on the price action, that's what it's telling me. What did you make of that?
I think the price action tells you that by the time you've had two conflicting messages within one morning, the second one coming at the start of an gilt auction, everybody's looking at the UK and say, please, 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 can you get the messaging right to us? We are all confused. Because you know what we need for the currency, what we need for the market is for the volatility to go away, for everything to calm down, and to put this kind of period of massive uncertainty behind us. So contradictory reports just don't help in that regard at this point in time. I mean, the most confusing thing of all next would be that although they're not planning on delaying the start of QT, if they go on and do it anyway because of the volatility in the gilt market at some point in the next couple of weeks, and then we'll be full circle.
Kid, I thought your
maybe
note,
some people should say less.
I thought your note today was really lovely, and it was very indeterminate. It was like, we need to wait, we need to wait. Now what? What do you do with a strong dollar reality, given the unsettledness of your note? Can you go the other way and call finally weak dollar, or do you just sit here?
I wish I could, but that's why I think that what we do is we get stuck with less volatility. I mean, there are two problems with looking for a weak dollar. One is you just have to embrace the idea that we're going to have the softest of soft landings in the United States and everything's going to be fine and lovely and the equity bulls are right. And the difficulty with that is if the economy doesn't slow, they'll hike more, not less. And we're going to get a very, very inverted curve by Christmas at this rate. So that's the first difficulty. And the second one, frankly, is still Russia, Ukraine, the whole problem that we have out there, that how do I turn around in Europe and say, I want to sell the dollar, shall I buy the pound, shall I buy the euro? When I'm getting newspaper reports about, if we have cold days in the middle of winter in January, February, the lights are all going to go out. Have we priced that in properly yet? I'm not sure. So we could get stuck here. I guess that's the end conclusion of that until we get the next trend, and the next trend might be kicked off by the next leg up in 10-year note yields.
Just quickly, Jordan Rochester was on yesterday of Nomura, and he was talking about how, central banks are important, but really it's about the economic trajectory. And right now, more of an austerity kind of approach from fiscal policymakers in the UK will lead to a deeper recession. And that means a more negative outcome for the pound. Is that the kind of rationale that you think is what you should be following? How much is the economy really the main driver here?
I think the economy becomes one once we stop focusing on the politics because it's not as important. And the economy is heading into a recession that could last a long time. And yes, to the extent that, that there's a sort of a wisdom out there that says what you need to do when your financial position as a country, when your fiscal position's poor, is tighten fiscal policy really aggressively, and in the hope that that'll improve it, as opposed to get yourself any chance of growing out of your fiscal problems, then we start looking more like Japan every second. And so, that's pretty scary for a country like the UK with the current account deficit and for sterling. So, yeah, it's not a great picture. I think the only piece about sterling right now is, we're priced for a lot of bad news. Sterling can be held down here. I don't know how much further it can fall unless something really negative happens. What I still can't see is the policies that would let the economy do better than expected, and people start looking around and saying, hey, this thing is a cheap asset that I want to buy.
Hey, Kit, final question. Can Arsenal win the league?
No.
Just flat out no. Are you saying no because you're worried that if you say yes, it won't happen?
I'm saying no because Manchester City are the best side in that league, whatever happened at the weekend.
Kit Jukes of Socchen, thank you. I've given Kit so much grief over the last 10 years or so on his support of Arsenal Football Club, and they're just refusing to engage the prospect of winning this title, Tom.
For American audience, where are we into? Are we still early in the season?
Still early, Tom.
Okay.
They're going to go on this ridiculous 1-month break for the World Cup, which is
just insane.
I detest the idea of.
Yeah.
Furious about it.
And to be clear here, for those of us that don't know, there's a team like Arsenal, all the different players go play for their countries. They've all got to go pay for their countries and then come back, and going to lose a lot of momentum. They could do anyway. They did that in hockey with the Winter Olympics. Never worked out. Sterling negative 0.75%, 112.74. What do they do? Do ice hockey in the summer? They do that anyway, don't they? Yeah, they do that.
That confuses the heck out of me.
Crazy.
I just do not get that at all.
I played hockey once at Davos. It was great.
Did you?
On the rink there, right?
Did you actually?
Yeah.
In proper skates?
After the fourth martini, it was something.
Do you remember when I played skating as well and ended up on my back on a hill?
Yes, I remember that.
Good times.
The annual Ferro fall down.
Yeah. Don't wear brogues in the snow. Okay.
Thanks.
Peter Cheer of Academy Securities joining us a little bit later from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. German Chancellor Olaf Scholz has ordered an extension of the lives of the country's 3 remaining nuclear plants until April 2023. The decision is meant to end a standoff between 2 coalition partners. The Greens are opposed to nuclear power, but the Free Democrats argue Germany should use all the generation capacity available to tackle the energy crisis. Slogans attacking President Xi Jinping, featured on banners on a Beijing bridge last week, have spread to other cities in China as well as across the globe. Now, phrases from the original handwritten banners have criticized strict lockdowns and restrictions that have defined Xi's COVID-19 zero policy and called for new elections. And Chinese junk dollar bonds have dropped to a record low as a property crisis is showing signs of improving. The notes are dominated by real estate firms, and the average price fell below 56 cents. It's hit that level before, in August, before government support fueled a rally. The Biden administration moving forward, releasing at least another 10 to 15 million barrels of oil from the nation's emergency stockpile. The move is said to be meant to balance markets and keep gas prices from climbing even further. The Strategic Petroleum Reserve release would be the latest in a 180 million barrel program that began in the spring. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Now, I recognise we have made mistakes. I'm sorry for those mistakes, but I've fixed the mistakes. I've appointed a new Chancellor. We have restored economic stability and fiscal discipline. And what I now want to do is go on and deliver for the public. We were elected on the 2019 manifesto. I'm determined to deliver on that.
You know when you got in trouble as a kid and your parents said you've got to go into school and sit in front of the teacher and this is what you're going to say. This is what you're going to say. And Tom, I'd sit there and I'd go, I know I've made a mistake. I'm here to apologise for my mistakes. Then I'd look back down at my notes. Can I go to class a little bit later? I mean, seriously, the last week or so, Tom, every time I see the Prime Minister right now, it just looks like an individual without any power whatsoever. After the events of the last couple of weeks, it's unreal.
What is your vision of how this is solved before we go to Lizzie here?
I don't know, is the answer, Tom.
A lot of people don't know.
Really don't know. Okay. All I do know, based on the events of the last couple of days, is it looks like the Chancellor's in charge. We know Sterling 112.89 is a litmus paper of this train wreck, and truly, what I learned at IMF, a global train wreck with ramifications worldwide. Lizzie Burden is in London. She is in front of the House of Commons with green leather, the House of Lords with red leather, and joins us this morning. Lizzie, I'm keeping count of the number of, I guess, Tory members saying out, and it was 2. And then I think now it's 4. What's the count this morning or mid-noon your time? And how many ministers have to say out before Truss is out?
I think publicly the herd is 5, which is not massive, and I don't think that there's a particular threshold that they need to hit to change the rules, because this is kind of a different situation. The Tory party is the most successful political party in the world for a reason. Like a snake, it can shed its skin. I think former Chancellor George Osborne said the other day that water will find its way downhill. So if they were to want to replace Liz Truss, they could find a way to do that, although behind the scenes it is said that the letters are going into Sir Graham Brady, the chairman of the 1922 Committee of Tory Backbenchers. But it's not just how they do it, it's also who would they pick. Yesterday in the Commons, it seemed to be an open audition between Truss's cabinet for who would replace Truss. You had Penny Mordaunt, the leader of the Commons, out to bat in place of Truss. She had to reassure the Commons that Truss wasn't actually hiding under her desk. But the problem with Mordaunt is she's thought not to have enough broad government experience to take over. Then you had the Chancellor Jeremy Hunt in his various appearances throughout the day, but he's already lost 2 leadership elections and he says that he doesn't want to go for another one. There's always Rishi Sunak. He's been notably out of the picture for the past few weeks, but he's seen as a really divisive figure in the party. Perhaps he's staying out of the way because he doesn't want to be seen as a backstabber in the way he was in the downfall of Boris Johnson. But interesting in Westminster, one thing I'm hearing about how Rishi Sunak could square the circle of not having to go to the public to get a mandate via a general election would be to claim that he has more of a link to Boris Johnson's mandate from 2019 because Johnson kind of went out for conduct reasons, not policy reasons, and Sunak would be closer to Johnson than Truss would have been.
Lizzie, I'll allow someone else to explore whether we can see Boris Volume 2. My question for you is focused on policy. The policy announcements of the last 24 hours, how have they been received? And are we ready to see much more of the same before the end of this month?
Yeah, markets do seem to have been pretty calmed by this. It's really hard to understate how much of a reversal it all was. Hunt has managed to close some of the fiscal hole, but he's still got £30 billion plus to go. And in a sense, he's reduced the need for a tug of war between the Bank of England and the Treasury by removing some of the stimulus. But at the same time, without the sugar rush, it raises the recession risks. The interesting thing is that whatever Hunt did, there was still going to be the moron risk premium. That's how T.S. Lombard's put it, because of the scarring to the UK's economic credibility done by Truss in that limited time. The borrowing costs for the government are higher. And so really, Hunt is going to have to show more fiscal discipline in the form of austerity. Labour's already branded it austerity 2.0. He's going to have to do spending cuts. And interestingly, he's appointed as an economic advisor BlackRock's Rupert Harrison, and respected as he is in the markets, welcome as it is that it's an acknowledgement of the need for this economic orthodoxy. Rupert Harrison was, of course, George Osborne, the former Chancellor's right-hand man in the austerity years. So politically, optically, it's a very it's a difficult link to be bringing back, this link to austerity. And as they head towards this Halloween budget, it's going to be very politically risky.
Lizzie, just quickly, you called it a moron premium. Was that Dario Perkins at TS Lombard, a moron premium?
Not my words, TS Lombard's.
Wow. Lizzie, thank you. Lizzie Burden out of London. That is brutal, Brammo, isn't it?
Yeah, it is pretty brutal. Right now, if you want to look at brutality, you can take a look at a poll that was done by YouGov in terms of Liz Truss's popularity. It's now at 10% of the people surveyed from October 14th to 16th. Yes, that was 10%. So just giving you a sense of that, that is a sense of scope, and that's really giving a real problem to her party. We haven't even touched on the Financial Times report about delaying quantitative tightening by the Bank of England. And then Bloomberg coming out and reporting that that's not accurate. What happens if they don't delay quantitative tightening? And if they do, where is the credibility there at a time when they've actually come out of this pretty unscathed and will look like they're blinking too?
Well, it's much more direct than that. It's the Bank of England themselves reporting, telling us that the FT reporting is inaccurate. What's problematic about all of this, and we mentioned it with Kit Jukes a little bit earlier, is that we don't have any understanding over the last month about the direction of policy of the Bank of England. And when you have a conflicting report like that in a really short amount of time, it again bakes in that additional premium into the gilt market of just not knowing anything about where we're going.
What would you call that premium?
I wouldn't call it the moron premium. I mean, maybe someone else wants to call it that. But I did ask the question last week, Tom, how deep the scars would be in sterling-denominated assets off the back of the mess of the last month. And the U-turn itself is not enough to heal them.
Yeah, I agree. The U-turn's not there because the powers that be are still in power. But if you get people changes for the Conservative Party, or number one, and I think this is how all Americans think, why isn't there a general election? We don't understand this, like the election sort of happens.
The parliamentary system.
Out there somewhere. We are like, okay, what's the date? When's there an election? Can Labor do it or not? Can the Conservatives do it or not? It's bizarre.
Stop making us all sound completely.
We're going to keep doing this.
Completely.
How many times have we had this conversation over the years?
It's uncountable. Yeah, I thought Lizzie was great there. Lizzie was clear, and we didn't have the Benny Hill music from yesterday.
Did you like that?
Well, I don't know. I like Ting-a-Ling-a-Loo, and I like Transistor Radio, and the other songs is done.
I think you probably know more about this than I do. Kristen Bidley's going to join us from City.
Without Benny Hill.
No Benny Hill music. Although that would be a great soundtrack for this programme sometimes. Live from New York, this is Bloomberg. Live from New York City this morning. Good morning. Here's the price action in the equity market, up by 1.4% on the S&P, on the Nasdaq 100 up by 1.7%. The earnings season continues, creeping further and further into earnings season, and J&J the latest to cut full-year sales and adjusted EPS outlooks on FX headwinds. I mean, how much more? Lisa Abramowicz, we're going to hear about that.
Yeah, how much is this going to be the catch-all versus really a huge problem, especially for international companies? But the shares are up 1.5% in pre-market trading right now.
Futures are up too by 1.4%. State of the bond market looks like this, 2s, 10s and 30s. Yields on a US 10-year shaping up as follows, unchanged on the day. By about 4% is your yield, 4% on a 10-year. On a 2-year, through 4.50 in the last couple of weeks, the last week or so. 4.45.19 is the 2-year right now. And sterling all over the place. Intraday trading looks like this on sterling. Cable now negative 0.75%. The range on this one,
really
Tom, from a 114 handle back to 112. The FT reporting that QT might be delayed. The Bank of England, this is the language they use. This morning's FT report that the BOE has decided to delay MPC gilt sales / QT is inaccurate. Now, I wonder if it's the decision part that's inaccurate, and I wonder if the conversation is actually active or not. I guess Tom will find out in the next couple of weeks.
I'll clarify it through the day to say the least. I'd also know dollar yen 147, 148, weaker yen 149.12 is something maybe off the radar, but all on global Wall Street glued to that currency pair. Right now, Kristen Bitterly joins us, and she has an exceptionally important single sentence of courage in her research note. Anytime the index has sold off by more than 25%, the 3-year future return has an average of 40%. Kristen, this is off the bounce. How do you know when to step in and go long?
It's a really, really hard decision, and we can understand why people are naturally nervous given everything that's going on. But I think for those investors that are able to take a long-term view, and 3 years isn't necessarily a long-term view, the data is in your favor, and time is certainly on your side. So exactly as you said, Tom, the 3-year forward return, anytime that we've seen the S&P 500 sell off by more than 25%, has always been positive and has averaged a total return of 40%. 5 years, it's actually 85%. So time is on your side. There are buying opportunities here.
Talk to us at Citigroup about the huge advantage you have, and I'm going to pick on Jim Suva today, but there's Horowitz and the rest of them. You've got these security analysts talking day to day to day with the corporations. Now, Moynihan came out at Bank of America, said business is good. J&J is giving some form of decent forward guidance. What are you hearing from your research staff about corporations are weathering this moment?
Yeah, so I think coming into Q3 earnings, and you were talking about this a little bit earlier, the bar has been revised down and set pretty low. So we could see some of those counter trend rallies on the back of it. But what are we watching and what are we listening for in earnings? All about the consumer. So obviously that was a key point in financial earnings, just listening to, is the consumer strong? Are they continuing to spend? I think there's a nuance here, though. So as we see credit card balances increase, as we're looking at spending patterns, there's a big difference between nominal and real numbers here. And so inflation is impacting our consumers. They are impacting spending patterns. And so inflation benefits top line revenue growth. So we have to get down to those unit numbers and see whether they're spending on the same things and whether they're buying the same quantity. And that's something that can flow through to earnings and put pressure in on Q4 and going into 2023 as well.
Kristen, I'm still stuck on the first point here, talking about history, not necessarily predicting the future, but being a guide for perhaps it is a good time to invest just based on how much stocks have gone down. And I do ask, is this time different? I mean, does that give you enough conviction in its own right to go all in with risk if you have a longer time horizon?
So to be fair here, Lisa, we are actually defensively positioned. We're fully invested, but defensively positioned in this market. We believe that these markets require patience, diversification, and discipline. So we don't want investors all in cash. And so in our portfolios, we're actually overweight fixed income. Ever since we saw, the 10-year right now at 4%, for investors who are in cash, and you even look out at 6-month T-bills yielding close to 4%, we want to basically increase those yields and see opportunities in fixed income, in investment grade, in government, in munis, and even in preferreds, where we see some opportunity as opposed to going long financial stocks. Getting that yield in preferreds of high single digits is something that's attractive and can combat some of the impacts of inflation.
So how much are you going to the long end of the curve? And I go there because a lot of people have been hesitant, saying, yeah, perhaps yields are close to their peak, but not quite yet, because we have seen the whole curve shift up again and again.
Again, this depends on the risk appetite of the investor. I would say the sweet spot right now, because we could continue to see some volatility, is probably out about 2 to 5 years. And most of our investors are long individual bonds. So that ability to be able to hold. And we have to remember that even just 2 years ago, we had 40% of the world's government debt was negative yielding. So seeing some of these yields out 5 years hit mid-single digits and slightly more is an area where we're comfortable, and we're comfortable holding and withstanding some of that mark-to-market movement.
Yeah, but in a balanced portfolio right now, I think of the great Margie Patel on this. How do you judge between, forget about 60-40 theory, it's all gone down in flames. How do you judge between bonds and equities? Are equities, given your enthusiasm, the new bond?
Yeah, so I think this is why we're actually pretty balanced here and pretty defensive. So we do think that we are going to see peak rates. We do think that we are going to see peak inflation. But what you're going to see dominate over the next couple of months is volatility. And so you will see these type of counter trend rallies. Like we mentioned, if you are playing that long game, there are certainly opportunities. But if you're someone who's looking right at the short term, what you want to have is that balance, because Q4 in U.S. equities, going back to 1936, 81% of the time has generated positive returns and an average of 4.4%. It is the best quarter for U.S. equities of any quarter throughout the year. If we have some surprises in earnings as well, but where do you want to be positioned there? You want to be positioned in dividend growers. You want to be positioned in sectors that will be able to withstand a recession. This is why you hear a lot about healthcare. Healthcare is a sector that's been able to consistently grow earnings through the past 4 recessions. at a clip of about 8%. Consumer staples is close to 5%. So you're not stretching too much there, but you still have exposure to equities.
What about high-quality big tech? I mean, we're coming into that season. I think it's October 27 is when we get Apple earnings. What about big tech?
So high-quality big tech, you were talking about this earlier. We have to look at the international exposure. We have to look at the pressure in terms of just how strong the dollar is overall. That being said, in technology, there's a huge difference between profitable tech and unprofitable tech. When we think of unprofitable tech, I like to think of that as a call option on an unknown future. So in long-term secular bull markets and low interest rate environments, that call option on an unknown future is much more palatable than in this type of market condition. So even when I was talking about the dividend growers, these types of companies exist within technology as well. And you could make the argument that a lot of the profitable tech, we're going to be looking for those signs of not only margin compression, but we're also going to be looking for signs of durable demand. Which of these companies continue to have durable demand, whether that's in hardware or whether that's in software?
Kristen, awesome to hear from you, as always. Kristen Piddley there of Citi Global Wealth Management. On the earnings and big tech there as well. Netflix after the close a little bit later, Lisa.
Yeah, how much are we going to see subscribers continue to decline? People are looking at subscribers.
What is the buzz? Is that what your way of asking whether you're watching
in
Netflix
my house,
right now?
Netflix doesn't have the buzz
Agreed.
it used to have.
Not on.
That's my
doesn't go on.
That's my basic take.
Is it all YouTube?
I don't know what it is. They won't. I think it's mostly this stupid TikTok.
Yeah, TikTok and Instagram. How much is social media taking over, and how much did we sort of see a saturation, and then try to crack down on multiple people using the same subscription and things like that? But how much does their subscriber count really increase, and then how much of a bubble have we seen in some of these tech names that got inflated during the whole pandemic when we couldn't do anything else?
You're watching House of Dragon on HBO,
No,
Tom?
I'm not.
You didn't go there?
Are you watching?
I don't know.
There are people in my household who do that.
What are they saying about it?
They like it.
I'm not there yet. No. It's a bit weird. It's a bit weird.
They're just Hollywood's just struggling. I mean, I watched the new Star Wars thing, and it was like, okay. What did it cost?
Well, that's the point. On a serious note, Tom, you've had the credit market supply extremely accommodative terms for some of these big companies to go out there and invest in some big projects.
Well, and this goes to the question that you asked yesterday, and we've been talking about, which is private valuations. And we're seeing in public markets, and I think perhaps that could be the takeaway from Netflix, how many of these companies that have gotten huge amounts of capital and investment, and they're a public company, but there are a lot of private ones, cannot even come close to justifying it with the revenue streams that they're seeing and the costs required to keep that up.
Weighted average cost chart on the Bloomberg Netflix, 18% weight on debt, Apple 5%.
There you go.
Right there.
That's the big difference, Lisa. You've been talking about that for a while.
Lizzie was great there. I mean, she's talking about a call option on an uncertain future. That sounds like my third marriage.
That was Kristen.
Kristen.
Lizzie was before that.
Kristen was before that.
Just keeping you on the straight and narrow there, Tom.
But it was like a call option.
I was like, I'm not sure where we are.
Sure, Lizzie said that.
No,
I'm pretty sure it was Kristen.
No, it's Kristen that said
a call option on an uncertain future.
Yeah.
Does Apple get it done? That's what it all comes down to. We reported in the last couple of weeks that they were struggling. Maybe iPhone demand was faltering. I've heard that a lot over the last decade or so when it comes to the iPhone, and then every single time they just come out and just knock it out of the park.
But this time might be different, just simply because of what we've seen from Micron, what we've seen from Intel, what we've seen from all the chip makers that have really had some pretty dire projections. So if that's a tea leaf to what the demand is for personal electronics, it's not exactly giving a good sign.
Big tech reporting in the next couple of weeks. Looking forward to that. Shape of the market today, shaping up as follows. On the S&P 500, we are pushing higher on the Nasdaq 100 as well. Yields aren't doing much at all, still in and around 4% on a US 10-year. For sterling, I just cannot keep up with pound sterling. The intraday ranges on cable are absolutely ridiculous. So the high of today's session was 114.10. The low was 112.64, and Lisa, we're just off that low right now.
And what's driving it and what it'll be in 10 minutes, we cannot tell you.
Is QT happening at the end of this month?
Well, and what does their denial really mean? I mean, you raised this good point. It's, what is it? Inaccurate.
They said the report was inaccurate, that the decision had been made. The idea the decision had been made was inaccurate. Look, the last couple of weeks in the UK, driving me nuts. Devin Ryan, Senior Research Analyst at JMP Securities, live from New York. He's coming up next. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Slogans attacking President Xi Jinping featured on banners on a Beijing bridge last week have spread to other cities in China, as well as across the globe. Phrases from the original handwritten banners have criticized strict lockdowns and restrictions that have defined Xi's COVID-19 zero policy and called for new elections. German Chancellor Olaf Scholz has ordered an extension of the lives of the country's 3 remaining nuclear plants until April 2023. The decision is meant to end a standoff between 2 coalition partners. The Greens are opposed to nuclear power, but the Free Democrats argue Germany should use all the generation capacity available to tackle the energy crisis. The Biden administration is moving toward releasing at least another 10 to 15 million barrels of oil from the nation's emergency stockpile. The move is said to be meant to balance markets and keep gas prices from climbing even further. The Strategic Petroleum Reserve release would be the latest in a $180 million barrel program that began in the spring. And President Biden's political travel schedule is lighter than his immediate predecessors at the same point in the midterm campaign. It's a challenge unpopular presidents face in trying to stave off congressional losses. During the same week in their first midterm campaigns in 2018 and 2010, former Presidents Trump and Obama traveled to 3 and 4 states, respectively, for political events. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Consumers are spending, they have money, they're employed, you can see the unemployment numbers, and they have good credit. And that's good news for America, but it also makes the Fed's job tougher because they're trying to slow down this American consumer, which is a very resilient thing.
I think Brian Moynihan just said good news was bad news. Brian Moynihan, the CEO at Bank of America.
Let's stop.
Ain't that the story? Ain't that the story? Go on.
This is so important. These are suits and ties, and everybody has some macro baloney questions about Jerome Powell in that. He stopped traffic in Davos with his precision on what he executed yesterday.
The underlying business, the strength of the consumer, household balance sheets, we all know this, and they're reinforcing it. The issue for markets is exactly what he said at the end. Bad news for the Fed, because the Fed wants to slow this down. And for many people, that means higher interest rates.
And this is what we've seen with all of the data. When it comes out, when it's good, people get really nervous and the market sells off. At what point, though, is good news just good news? And I hate this phrase, and we all do. And yet with the earnings, that seems to be what's happening more of the time than not, at least.
I saw a chart recently on the average credit score in America. I was shocked. It was like high 700s at some of these banks. Isn't that surprising to you?
Yes. It's a question of whether...
That was the average credit score?
So how much is this juiced by either selection, or how much are those credit scores inflated and are going to come down rapidly once the whole equation changes economically?
I would love to know, Lisa. I'd love to know.
A lot of people would.
I'm not going to share my credit score on air, Tom, but I was surprised that was the average in America.
Yeah, well, they've adjusted. I think they made it easier.
What's your Uber score?
I think to help out
Very
Americans.
proud of my credit score.
Do they have credit scores in the United Kingdom?
Yeah, they do.
All that?
Yeah, we do. Yeah, same thing.
Very good. Right now, and this is important for global Wall Street lean forward, as we talked about, not the doom and gloom, but the challenges of Goldman Sachs. Devin Ryan is senior research analyst, JMP Securities, out of Rhode Island, a Citizens company. Thrilled he's with us today. And what you need to focus on is his tenure at Sandler O'Neill. He parses banks like no one. Devin, I'm going to cut to the chase. You could have called your research note baloney, and you say this is a return on equity juggernaut, and Solomon and company are going to launch up 50%. What does the gloom crew get wrong on Fortress Solomon?
Hey, Tom, good morning. Well, I think the gloom crew, it's more of a near term versus long term. So I think in the lead in, there's a lot of uncertainty in the macro backdrop, and banks, financials, Goldman Sachs, really not the first place people are going to be leaning in when there's uncertainty. So, Goldman is now trading at 1x book value because of that uncertainty. But, if you take a step back, historically, Goldman Sachs trading at 1x book value is a very attractive proposition. And I would actually argue it's a better proposition today because their return on equity is more durable, and we expect that they can do double-digit return on equity for really the foreseeable future. And even in this really tough backdrop, in what we'll see today, I think is a return on equity of 10% or higher. And so that's really it. It's just people are concerned about the macro, and we appreciate that. We're not dismissive, but this is a long-term, pretty big opportunity in our opinion.
I made a joke about it earlier, but it's not funny. There's a reorg yesterday. Will they execute this plan to your up 50% with or without Mr. Solomon?
Well, I think Mr. Solomon is an important part of the equation, and I think he's done actually a really nice job. To me, that reorganization is a little bit more just exactly what that is, just getting a little bit more organized around the business units. I don't see really too much strategically changing. It'll change, how they report their results. And so it'll give people a little bit better sense of how different businesses are doing. But it also is a testament to, I think, where some of these newer businesses are going, like transaction banking, which really they started from scratch a couple of years ago and has already become what I would argue is a scale business, and they're starting to nip at the heels of some of the legacy incumbent banks that have been doing that for a long time.
Wait, hold on a second, Devin. You said that you think that David Solomon's doing a really nice job. A lot of people probably would disagree, including the board, including some of the people who have to now reverse some of his changes and who call Marcus a big mistake. How would you push against that and say, even though it is losing money, even though it hasn't gained traction, it's not a mistake?
Yeah. So, on the consumer side, you don't start a consumer business and reach scale in 2 years or even 5 years. And, the business is losing, maybe $1 billion or so in that ballpark, which isn't immaterial, but relative to a firm that's going to make well over $10 billion on the year, it's manageable, $40 billion, in revenues. And so, in our opinion, this is part of a longer term opportunity for the company, and I do think they're gaining market share. They're the first digital bank to $1 billion. I cover fintech very closely. A lot of the fintech firms are really struggling in this environment because they were operating business models that were really trying to be lost leaders to gain market share. That doesn't work anymore. And so Goldman Sachs, in our opinion, these are the moments where you gain market share and you separate. You don't necessarily see it in that very moment as it's happening. So I actually would push back and say that David Solomon's been navigating a tough environment really since he's taken the helm, and we are pretty constructive on some of these moves into these new businesses like consumer banking, transaction banking, what they're doing in asset management as well.
Just quickly here, Devin, what's the proposition for a consumer-facing industry at a time when we're heading into a recession by almost all accounts?
Yeah. So again, you're not going to build the business for a recession, and recessions happen. But this is a long term. Goldman Sachs is building what's the next 100 years of the firm, and so in the very near term, consumers actually been hanging in, I think, better than a lot of people thought, and that's why some of these banks are posting, I think, solid earnings. But I think it's an area that we're a little bit concerned about over the intermediate term. But that really shouldn't derail, in our opinion, the longer term story here, which is diversifying the business away from legacy parts of the market that are just not high growth. Capital markets do well when the economy is roaring. When the economy's not, like we've been in this year, they're softer. Investment banking's down 40, 50% in some areas. On the other side, consumer is kind of chipping away and slowly growing. And we think that that's an area for Goldman that, they're going to gain market share and will be a big story.
Hey, Devin, thank you. Devin Ryan there of JMP Securities. Just had one person message me over to Bloomberg Terminal subscriber, and they're looking exactly what I was looking at. The savings rate on a Marcus account, 235. 235. Would you take that, Bramo? 235?
Compared to what you're getting at JP Morgan or Bank of America? I mean, yeah, it's a lot higher, which is the reason that's their big proposition.
Yeah, and the math works because net clean of the 2 and 20 I take on triple leveraged all cash. Triple leveraged all cash gets down to about a 3.1, maybe a 3.2 net of the 2 and
It's
20.
actually a really good message. They say Marcus pays out 235, 2-month bills pay out, they yield about 350. Why aren't they just clipping 114 basis points in a minimum savings? And,
there you go.
And then they're asking how they're losing money.
That's a conversation from the 70s.
Well, but this is the issue, because right now you're seeing Marcus offer these rates because they are trying to attract deposits, and arguably the JP Morgans of the world are not, because they don't care if you take your deposits out, apparently, because they've got too many of them. So it's sort of the haves and the have-nots, and why aren't they just clipping those coupons?
Can I say out on Twitter, Sam Coates of Skies, there's a cabinet meeting this morning.
Sure.
And they're like,
who's running that?
It's like nuts, absolutely nuts over there.
Sterling right now 112.66. I agree. It is nuts over there.
Nuts.
Okay. Peter Cheer of Academy coming up from New York. This is Bloomberg.
This cycle is being defined not by its severity, but by its duration.
Higher global interest rates, lower equity prices, and a stronger dollar, we think will continue into year-end.
I just think the stock market's washed out.
I think that 3,200 mark, if 35 doesn't hold, I think 3,200 is the next natural place to go.
I get it that we're probably not at the bottom, and there's more stress to come, but things are starting to look pretty reasonable if you can take a longer time horizon.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Futures positive 1.35%. Later this hour, TK, Goldman coming up.
Goldman coming up, and as we just heard from Devin Ryan there, an optimistic view given all the turmoil in the reorg yesterday. But as we mentioned in the last hour, John, Goldman comes now on the back of Bank of America. I'm sorry, business is good. JP Morgan, I'm sorry, business is good.
So far, so good, Bramo. That's the story of earnings season. Early days, but so far, so good.
Early days, I would emphasize, because right now we've seen the banks. The banks are doing great because of the interest payments and because things have not frozen up, so they can still continue to clip the differential of what they're willing to pay out to the depositors, which is nothing, and then what you're getting in the T-bill market, which is quite something. So, how much does that really get reflected in the rest of the world? And we start to broaden out today.
Isn't that the conversation we had 90 days ago? Exactly, verbatim.
Yes. What have we learned? What are we learning? We're learning. We're basically confirming
no, I don't mean you,
everything we already knew from these banks, which is the consumer's strong, balance sheets are good. If we have a recession, it's going to be short and shallow because they keep on asking, where's the excess?
Which raises a question of, are we going to be stuck with stocks rallying 6%, 7% in one day for a prolonged period of time because we have no visibility and no guidance? Even the companies don't, because it doesn't seem like anything's changing. But if you take a look at what's happening with rates, if you take a look at what's happening in some of the granular data, it is changing.
But maybe in your brief, you mentioned this last hour, maybe you're going to mention it again. I'm sorry, is United Airlines of more descriptive value to the market than Goldman Sachs?
I think so. In terms of the consumer, Tom, is that what you're talking about?
Yeah,
spending,
Scott Kirby's going to come out and say,
I hear what you're
this
saying.
is where we are. I'm sorry, I think it's just as important. It's not, is it FedEx? No.
Whatever you look at, all roads lead in the same direction. This Fed is going to do more. And that's why many, many people just believe it's 75 again, Lisa, in early November.
The bigger question to me is whether it's 75 again in December, whether we get to 4.75% by year end, and how much that shifts a conversation when we were talking about the likelihood of the peak being much far below that. And that's why I say front loading is going to be really important. Is Jim Bullard leading the psychology here in terms of what needs to get done, especially given the upside surprise in CPI?
I know I'm a broken record, and I know I've said this a million times, but I want to say it again, just briefly, just a couple of seconds, allow me.
Please.
In the December Fed meeting, they did not even project rates, the median dot, at 1% by year end this year. And we're talking about 4-5 handles year end. That's a monster shift.
What else are we getting wrong? Especially given how much everyone has come to this impression. If you take a look at Fed funds futures, people are on board. They see the peak being somewhere around 4.9%. We are getting close to 5% as a base case for this market.
That's precisely the question I'm asking, Tom. We got this year so wrong. For this Fed, just 10, 11 months ago, what are we getting wrong about 2023?
Let's join the Broken Record Society, and I'm going to say we've had higher interest rates before. We did not die. Things move on. Corporations adjust to this and find revenue and earnings. Even J&J with what? FX headwinds? Okay, it's a worry, but it's not the end of the world.
Are we accepting membership? subscribers
Here we are.
to the society.
Yeah, of broken records.
Of broken records. Here's
Some
your
of our
price
audience
action.
doesn't even know what a record is.
Equity futures on the S&P.
Save us with a data
at 1.5%. Equities kicking higher. Equities doing okay. We get Goldman later this hour. Netflix after the close. More earnings still to come. Brahma's going to run you through the day ahead in just a moment. Your 10-year yield in and around 4% on a 10-year maturity.
Well,
in the
there it is.
FX
That's still
market.
stunning.
Euro
Stunning.
dollar negative 0.2%, 98.24. And crude. Tom, did you see the latest reporting from the team down in DC? The White House could announce later this week another SPR release.
Yeah, at 85.42 West Texas Intermediate, that sort of surprised me, and that, that's like the ammo the gunpowder you use at 100.
So midterms coming up, aren't there?
Yeah,
isn't that what this is down
that
to?
just might possibly have
can we
to do
talk
with
about the politicization of the SPR a little bit later, maybe?
Does Britain have an SPR?
I'm not sure we do, Tom.
I don't know. It's under 10 Downing Street.
I think Liz Truss would be running it down right now, though. That's for sure. Crude Bramo, 85.35.
Coming up, we'll be speaking about the politicization of the SPR. No, I'm just kidding, although we probably will. Today, we're talking about earnings, including Goldman Sachs at 7:30 a.m. at about a half an hour, Netflix at 4 p.m., also United Airlines and J.B. Hunt after the bell. I do think, to your point, both Tom and John, that some of the other earnings might be more instructive than bank earnings this particular season, just because banks are not the bellwether necessarily on the economic growth as some of these other companies. They might have more of a front-running tea leaf kind of feel to them than what we're seeing out of the big banks, which are really hanging in there better than people had expected. Today, we get economic data, including U.S. industrial production at 9:15 a.m., as well as NAHB housing market index data at 10 a.m., which is positioned to see home builder sentiment fall to the lowest going back to 2012. Tom, you've talked a lot about this. How much is that rolling over? When does it start to bleed into sentiment among consumers with house prices declining, with this feeling that perhaps we are entering some sort of housing market downturn that we have not seen since 2008? And we have a host of Fed Speak today, including Atlanta Fed President Raphael Bostic at 2 p.m., Minneapolis Fed President Neil Kashkari at 5:30 p.m. This is my issue. I want to know about front loading. I want to know if it's really a likelihood that we can get to 4.75% by year end. How much does that really change the equation for people, John, who increasingly are saying that perhaps the Fed needs to wait a bit now, take it slow, and understand how much they're actually impacting the economy? Because there is a 6 to 12 month or 12 to 18 month lag time that people talk about that we haven't gotten to.
Hey, Lisa, thank you. Tom, the long and variable lags of policy. The long and variable lags.
Yeah, well, that's codified in all the textbooks, and the answer is coming off a pandemic. It's a little bit different. You see that in the volatility of equities, and particularly what we've seen, the carnage in bonds.
Peter Scheer joins us now, the head of macro strategy at Academy Securities. Peter, your words, the wall of worry is so big we can climb. Peter, can you explain that for me?
Yeah, no matter where we look, whether it's Russia, whether it's energy, whether it's China, our own earnings fears, there's so much fear out there, and it's been priced in. So I think we get this little bounce. It started nicely yesterday. It's continuing today. And what I really like is yesterday afternoon, stocks held on even as bond gains gave up. And overnight, we're doing well, especially on the NASDAQ, with bonds not doing much. So I think that's an important change that we've seen these past couple of days. And I think that leads us to a further rally.
Peter, frame it around the VIX right now. We've not seen the catharsis that a lot of people say we need out to 38, 40, even 42 VIX. We're locked at a 32, 31, maybe a 30 handle right now on VIX. Frame your enthusiasm when you study VIX.
So I see that going back below 25. I think we're kind of in this lull, right? We're getting these earnings, but we've priced in so much negativity. I think we're going to get great earnings from the airlines, for example. They're coming out today. I think the consumer companies are still going to be struggling a little bit. So much is priced in, we can see VIX come down. And then the debate's going to start switching, as you've already said. Okay, 75 for the next meeting, but what about the meeting after that? And I think we've got ahead of ourselves. Let's see how some of this data comes in. CPI was very misleading last week. We had the shelter component, which was the highest it's been on any given month since 1990. And there was no way that rents were the highest increase in a month in September. So there's a lot of bogus and lag stuff coming into the data. So I think we're going to get some relief on the Fed front.
Okay, Peter, I just want to understand the new consensus, because it seems like there is a new consensus forming that we could see potentially rallies in the near term, but over the long term, we probably haven't seen the lows. And this is something that a lot of people have been discussing as we start to see some of the weaker data come in. So can we infer that weaker data is really going to be in the driver's seat and not necessarily a Fed pivot or pause? I hate using this word, but some kind of retracement by how quickly the Fed's going to be going?
Yeah, I think we're going to be looking, say, let's call it data dependent. And as the data weakens, at first people are going to, oh, this is okay. It allows the Fed to pause. There's going to be some concern. This is actually going to be good. We get rates stabilized. My real concern is that then the pendulum swings way further and the data is so bad that people have to really pull back from risk. So that to me is the final stage, is a real risk off type rally where you see much lower yields, much lower stocks. But I think we still have a small chance of a soft landing. I don't think we get it, but that's what the market's going to start pricing in first, is a soft or softish landing. And that's going to drive this rally.
Pete, we've all heard the same arguments as to why this will be short and shallow. The excesses aren't there. They haven't been built up in the same way. The balance sheets are stronger, both on the consumer side, on the corporate side. Pete, I know in a way you push back against that, Pete. Just give me the shorter story as to why you push back against that argument.
So one, I think the wealth destruction has been immense, and the wealth destruction has been very concentrated in a lot of these, not just individuals, but the companies, and they were the ones buying tech. They were the ones really pushing out tech. They were the ones buying semiconductors. You're seeing that pull back. You've seen this supply chain shock where companies are adapting to it, right? They're changing how they use semiconductors. So I think there's going to be this, big drag on the economy, and everyone's completely ignoring OPEC Plus when they did say they're seeing less demand for energy. I think that we could have a much deeper recession. And I look at it, the consumer part of the business, right? $2 were being spent on goods last year. Right now, they're spending $1.50 on services. Once that gets captured, what do we look at next January? So I think it's very unclear how the consumer does come January.
Hey, Pete, wonderful to hear from you, buddy, as always. Peter Cheer there of Academy Securities. Lisa, we've heard the same arguments, haven't we? The short and shallow recession, there are no excesses. This cycle's been really short. We've still got the benefits of those huge fiscal transfers in a pandemic. Where's it going to come from? You heard some pushback there.
Yeah, and how much does this really lead to the new consensus? And I keep going back to this, that Mike Wilson has been out in front, but it seems like other people are kind of coming to the feeling that people haven't fully appreciated the weakness that's going to cause the Fed to take their pedal off of the brake. How much is that really going to drive a new bout of weakness? And then to your point, what does that shake out in terms of the excesses, right? Because we have seen, at least with the Bank of England, that a sudden move can really pull a lot of things out of the woodwork that perhaps were unexpected.
We've got another big move today. We're up by 1.6% on the S&P. Mike Wilson and Morgan Stanley, who you said, Lisa, seems to have a crystal ball, talked about the prospect, the scope for a bear market rally. Heard the same thing for the fund manager survey over at BofA, but ultimately, Tom, for the lows and the big rip, BofA and Mr. Hartnett say no cuts, no glory.
There's a lot of technical damage. I just looked at an exponential moving average study. We are nowhere through resistance on a rebound. We need to do a lot more work.
Futures up today in the next hour. Andrew Sheets and Morgan Stanley. Looking forward to that conversation. Goldman Sachs coming up in what? About 30 minutes time, Bramo? 20 minutes away?
20 minutes.
Goldman coming up a little bit later this morning. Then on to Netflix after the close. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Just 10% of Britons have favorable opinion of their Prime Minister Liz Truss. That's according to a YouGov survey. Now, the results come one day after Truss was forced to pull back on the bulk of her economic vision for Britain. Some 80% said they had a negative view of Truss, giving her a net favorability rating of -70. Russian missile and drone strikes targeting Ukrainian power infrastructure over the past week have failed to knock electricity supply off the grid for any prolonged period, according to the International Energy Agency. Hundreds of recent strikes have targeted power plants and electricity substations across the country. Chinese junk dollar bonds have dropped to a record low as the property crisis is showing few signs of improving. Now, the notes are dominated by real estate firms, and the average price fell below 56 cents. It's hit that level before in August, before government support fueled a rally. AT&T is counting on stimulus dollars to help fund its broadband push. The wireless giant wants small towns to use federal economic recovery money to cover the cost of landline high-speed internet to rural and remote areas. CEO John Stankey met with local politicians and residents in Indiana about using American Rescue Plan money to cover a portion of its fiber network expansion. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
12% upside from here to the end of the year makes a lot more sense than almost 33% upside based on where the S&P closed on Friday. So we're still bullish on equities. It's just going to take more time until the Fed has effect on curbing inflation.
Still bullish, but not as bullish as they were. That was John Stolfus, Chief Investment Strategist at Oppenheimer Asset Management. They've gone from 4,800 down to 4K, but 4K is well above where we closed just yesterday, even with some of the big moves we've seen recently. Here's the price action for you. Equity futures pushing higher on the S&P 500, up again this morning by more than 1%. On the S&P, up by 1.6%. Yields a little bit lower, down a basis point or two. Just cracking 4% on a 10-year, south of that level at 399.22. Tom, Goldman out a little bit later this morning. Should be in the next 10 minutes or so, and we'll break those numbers down with Sonali Basak imminently.
Really interesting, the reorg yesterday, and of course what we just heard from Devin Ryan at JMP, who's looking for an up 50% on Goldman Sachs over total return kind of 1 year basis. We're going to digress here real quickly with Maria today on international relations, our Europe correspondent. She is in London today. Maria, I believe it is all quiet on the Northern Front. And the Northern Front is a backstory in the media right now, and that is Belarus. Explain to us the dialogue between Moscow and Minsk.
Well, Tom, that is a key relationship, and it goes back 2 years ago. Remember, Lukashenko at one point really feared that his grip on power was going to decline. Vladimir Putin stepped in, but of course the condition now is that he plays essentially his puppet. Now, Lukashenko will never say that he is, but in many ways he has participated in every way that is convenient for Russia. And you make a very good point. The Ukrainians say, let's be honest, the Belarusian army is not in good conditions, and they're not going to go and fight to kill, quote, their Slavic brothers in Ukraine. But it is a distraction for the Ukrainian army, which at this stage will tell you they are focused on the southeast. By the way, the Europeans also say, watch out, Belarus, there could be more sanctions to come if you join in this effort. But ultimately, the key question is, what does Vladimir Putin want out of Lukashenko, and how willing is he to say yes to everything he demands?
What is the European response to the news and the footage that we've seen the last couple of days of these drones?
Yes, and Tom, that is the key question. And when you ask European officials, I was on the phone this morning entirely with European diplomats. There's a number of things. We know now that these drones have destroyed 30% of Ukrainian power plants. A lot of this has to do with the winter season. What they want is essentially Ukrainians to freeze. That is part of the morale war that also plays into this. And then the Europeans, well, what they argue is that they want to find out if this is essentially Iran that has supplied this. If they supply this kind of technology to Russia, then it means that more sanctions are to come. But also, by the way, the Iran nuclear deal, well, you can kiss it goodbye, because the only really engaged side here was Europe. And they say if you get belligerent with the Russians, that's also the end of story. Expect more sanctions.
Maria, in the meantime, Europe is trying to come up with some sort of energy plan. I honestly cannot follow the inner machinations of this and what the price cap means and who's on board and who isn't. Can you offer us some clarity on that?
Look, I think we are actually, and this is what I'm looking at my phone every 10 minutes, because we are going to get the head of the European Commission, Ursula von der Leyen, with an executive roadmap. Remember, she said gas prices need to come down. They have come down from August, but they need to go down further. We're expecting is a combination of measures. Now they talk about a dynamic price cap, which is essentially is a cap that's not really a cap. It's more a trade up. If there's a lot of volatility on one day, you halt the transaction and you close it for the day. The key is the percentage of volatility that they will allow. And then the other big thing is that they want to leverage the power of the European single market to buy gas jointly in this market. I would say one thing, Lisa, and that is every official, every diplomat that I speak to, they tell me I am less concerned now about the winter that I was 2-3 weeks ago. The real question now is, what do we do the next winter without Russian gas?
Maria Tadeo, that is the number one question. Maria out of London today. The European tour continues for Maria Tadeo, as it often does, Bramo, as we know. Anyway, her point there on gas. Gas prices have come down in Europe. That's important. And the fear of a very, very cold winter, I think, has been parked somewhat over the last couple of weeks.
And we see natural gas prices I think, at about a 3-month low in the euro region. That said, how much could that change, especially as they see the pace at which some of the natural gas resources are pulled down, but also the lack of ability to rebuild? And that's what Maria has touched on. Sure. That's what you've talked about. How much they really still talk about idling factories or coming up with some sort of cohesive plan to limit manufacturing at times of peak use. And what does that do to growth?
It is going to be very, very difficult to repeat the act next year without Nord Stream. Anyway, we'll focus on that a little bit later. We need to talk about Goldman too. Shonali Basker around the table with us, our Wall Street correspondent. Shonali, imminent, a few minutes away. What are we looking for from Goldman Sachs this morning?
Details behind that big reorganization, but we also shouldn't get distracted from the numbers themselves, because we are going to want to see Goldman still beat on the things that they're good at, that is fixed income trading. We had Morgan Stanley bring in a 33% jump at that business. We want them to hold strong in equities because it's a time to gain share when the whole industry has been shaken up. And consumer, we've been talking about it all day. You guys were talking about it this morning. Those rise in deposit rates at Goldman have been higher. And you are seeing numbers come out now as we speak. So let's take a look at those. But really, to your point here, they have been spending more for those deposits as they build this business. Are they going to see that as something that was worthwhile or something that they need to change course on?
I'll pick up a couple of the numbers, Shonali, and you can get digging into it as well. So third quarter investment banking revenue, $1.54 billion. The estimate, $1.63 billion. Third quarter trading revenue, $6.2 billion. The estimate, $5.69 billion. If you break that down between equities and FIC, let's do equities first. Equity sales and trading revenue, $2.68 billion. The estimate, $2.65. Looking at FIC here, Shonali, sales and trading revenue, $3.53 billion. The estimate, $3.04.
So that strong beat, right? That's what I was talking about right there. And as they consolidate those trading and investment banking businesses, you have them coming in stronger than their rivals. And I think that's where the rubber hits the road for Goldman Sachs. Now, again, they are putting out all those details on what that new business looks like. I think this will take a while today for the market to absorb as David Solomon walks the market through those numbers. Because again, what does this mean for the future of Goldman Sachs? You are looking at revenue coming in above expectations. You're looking at ROE also coming in above expectations, really matching that of Morgan Stanley. They're more efficient than Morgan Stanley typically, but again, if they're making the same in terms of returns, what is the market going to prefer?
Very quickly here, we're going to come back after we digest these numbers as well. I look at the long-term track record across 4, 5, 6 managements. Big banks outperformed Goldman Sachs. Has Goldman Sachs been a decade or 2-decade underperformer?
I mean, you're looking at today, it trades at less than price to book. Wells Fargo is even more than that, Tom.
Wells Fargo trades at a higher book?
Yes. So
that's stunning.
Exactly.
Stunning.
And Wells Fargo, with all the problems that it has and still has, you're still seeing them trade higher than Goldman Sachs, that does not have half the regulatory overhang today than it did have 5 years ago even. So what is it that the market is not latching onto with Goldman Sachs? You are seeing the market now rewarding Goldman for those trading numbers, really, again, much stronger than all of its peers. So they're not showing just a strength in a tough market. They're showing market share gains.
Hey, Shonali, thank you. Stick around. Lisa, up about 2% in the pre-market.
How much does this give David Solomon a bit more lifeline to build out his vision?
We'll continue building out these numbers for you in just a moment. We'll catch up with Gina Martin-Adams of Bloomberg Intelligence. Live from New York City with Goldman up a little more than 2%. I think Wall Street got it done, didn't it, in the third quarter? Let's see about 4Q and beyond. This is Bloomberg. Two hours away from the opening bell, live from New York City this morning. Good morning. The price action shaping up as follows on the S&P 500, pushing higher, much, much higher, up around about 60 points on the S&P, climbing higher by 1.6%, advancing 1.88% on the Nasdaq. The earnings so far, so good. Goldman, the last one to cross the line just about 5 minutes ago, and hopping over a low bar in a massive way. Trading revenue beat was a monster. Shonali's going to talk about that in just a moment. In the pre-market, Tom, we're up by a little more than 1%.
It is. I mean, the side of the argument here is a reorg, doom and gloom. Solomon, is he going to survive, et cetera? And John, I'm looking at this beautifully laid out, very traditional press release, the expansion of it. And I got to go to the bottom of the press release where itty-bitty consumer. It's
I'm
it's
smiling.
like,
we do this every single earnings season.
Yeah.
You give them feedback on the press release.
I do. They call me up.
Okay.
No, they call me up. They got
you like Goldman's.
I like them all. They've all gotten better.
Oh, you like them all
They've
now?
all gotten better.
Okay.
They've all gotten better.
Who executes less well?
Wells Fargo.
Okay, you don't like the Wells release.
It's just what you said. It executes less well.
You think it's clumsy?
I need to know what's going on a percentage basis fast. I got to try to keep up with Chanel best.
You don't like the font?
Yeah, I was about to say it's a font.
Sometimes it's the font.
It's often a font
Frankly,
thing.
it's just readability.
I can't
It's
even
just-
read a release anymore without having Tom's voice in my head.
Yeah.
So
Saying change the font.
Readability. Bank of America, I thought
right.
is really clear, very charty. Bank of America is very charty.
I'm sorry to distract from this, but I do want to talk a little bit about some of the details of this, which is actually
let's do that.
fascinating. In
How
particular,
dare you?
I know, I'm really sorry. It was illuminating. But Goldman Sachs, with their fixed income trading revenues, as Shanalia was pointing at, really blowing it out of the water. And how much is this taking risk again at a time when spreads are very wide and liquidity is a question, and you have traders are actually able to be market makers once again?
41% jump in fixed income trading. That's nothing to cry about. That is bigger than any jump we've seen at any other Wall Street desk by a percentage point year over year. Now, if you listen to what Bank of America's Brian Moynihan had told David Weston yesterday, what he had said is they don't want to be taking on too much risk. They want to be moving risk. They want to be getting it off their balance sheets quickly. The 10Q and what they are doing in terms of daily trading losses and value at risk will be interesting. Goldman Sachs' traders are coming to work. Now, also in the press release, very high up as they reorganize the business lines, they show you what the consumer is getting you.
Let's go to the consumer at the bottom of the page yesterday. Marcus, it's a failure. I don't see a failure on the page. Explain.
So what we're seeing in terms of numbers at the consumer and wealth business is record net revenues and double what you saw a year ago. It beat Wall Street expectations by $100 million. So even though this business is much smaller than the rest of them, they're still bringing in money. And remember, you guys were talking about
Then
it.
what's the impatience about? I just don't, I'm lost.
Profitability. Now, they have raised deposits, the savings rate for their customers, high yield savings account, much more than you've seen any of their peers. JP Morgan, Bank of America, when asked, they won't tell you that they will do it anytime soon. But Goldman Sachs wants those deposits. It lowers their cost of funding. So this is not a business that looks like it's going away. This is a business that is going to be different than maybe we thought it would be in the past.
Just quickly, final word on headcount. You've been following this story over the last few days. Yes. I can see the number from Goldman. The headcount increased 4% compared with the end of 2Q. What are we learning about what's happening on Wall Street with the headcount?
We're learning that the numbers are holding up better than expected. Even if you're not seeing big scale M&A, big deals happening, you're seeing spinoffs, you're seeing potential restructuring around the corner, and you're seeing customers that still need to figure out what to do with their business and then hiring firms like Goldman.
Edge of November, what's the ballet into February of next year?
I don't want to say that there's not anxiety on Wall Street. Of course there is. Everyone's preparing for bonus season already because they are looking for what the best job is heading into next year. Competitive among the buy side, competitive among the investment banks, but they will be efficient. They will keep a lid on costs, so the bottom performers will go.
Goldman up, Tom, by 2.28% in the pre-market. Shanalia, thank you. Just awesome as
always.
That
was just great.
Fantastic.
And your wisdom there on
Do you
Wells
take the rest of
Fargo?
the year off now, Shanalia?
Yeah,
You've done for like 3 months.
We're sharpening our pencils for the rest of it.
You get 3 months off after earnings, right?
Yeah, that's
done.
It. Checks out. Your idea on Wells Fargo earlier was just brilliant. I think we can pull that right over, Shanalia, to Gina Martin-Adams joining us right now. Gina, Shanalia had the insight that Wells Fargo's book is actually better than Goldman Sachs. That seems like the mother of all opportunities on the sell side. Jamie Baker over at JP Morgan and others, you know, they're looking at the airlines, a double. They're looking at Goldman Sachs, JMP Securities up 50%. Is the sell side out front of this earnings recovery?
I think the sell side actually has gotten too bearish on the earnings growth in the near term, but anticipating a recovery into the next 12 months. And this is classically what's happened pretty much every quarter since that devastating sort of fourth quarter release season at the early start of this year, is analysts have clearly struggled to get the bogey right on 2022. They really severely cut estimates into second quarter earnings, first quarter, second quarter, and now third quarter earnings season, reflecting that sentiment. But companies continually come in and beat those expectations. But it's a near-term revision cycle. So they're not saying, look, next 12 months is going to look awful, but they are capitulating to the short term. And that's what we saw headed into this earnings season once again. Analysts were expecting nearly 10% earnings growth in third quarter as of June. They're now all the way down to 2%. So, of course, companies have helped them by guiding them to anticipate less, creating a much lower bar, but nonetheless, companies are able to beat 2%. And that's what we're seeing so far this earnings season.
Traditionally, Gina Martin Adams, we talk about banks being the tea leaves and banks being the front runners and JP Morgan kicking off the season. Is this time different, where banks really don't give us much of a read at all on the rest of the complex of corporate America?
You know, I would argue, Lisa, that's been the case for a while now. We've gotten really accustomed to banks actually disappointing us relative to expectations, and that's not necessarily been a predictor of what to expect for the rest of earnings season. Now banks are beating expectations. Maybe that's not a predictor of what to expect for the rest of earnings season. Banks do tend to march to their own drumbeat. Yes, we want to look at the consumer read-through. We want to look at lending growth, but in an environment where liquidity is extremely ample, easy to access, that sort of lending queue has not been particularly profound as a driver of overall economic conditions. Obviously, companies, for example, are getting tremendous amount of cash. They're still sitting on large cash loads. They're still generally producing some cash flow. That is funding operations and certainly funding activity outside of financial sector lending conditions. Credit spreads, likewise, have been very tight relative to past experiences of stress. So credit has been somewhat ample, especially over the last year. So I think that the financials, while they are an indicator of some things, they've really lost their lead in a lot of ways. Maybe that lead is reestablished over the next couple of quarters, but this year in particular, we haven't seen financials operate as a leader.
Is there a leader? And I ask this at a time when we talked about United Airlines, for example, or some of the airline companies that might be benefiting disproportionately from business travel, from upper income individuals who are still able to travel even as lower income individuals pull back on spending at certain retailers or certain consumer facing shops. What is the industry to watch?
Yeah, there are three segments that are very traditionally leading indicators of overall market activity as well as overall earnings trends. Those are semiconductors and the technology space. Obviously, that's been an area where we've been watching inventories very closely. There are home builders in the consumer discretionary space. Notably, home builders have actually broken out of a downtrend. Will they be able to establish a steady pace of earnings growth over the next year is a very huge question. And then the third is transports within the industrial space. Those are the three segments that are true leading indicators of actual economic conditions. They're the most important segments to watch for earnings cues going forward. Yeah. I'd say the only other thing I'd load up on in there is mega cap stocks. The 5 biggest stocks in the index are now driving roughly 20% of income. They're about 25% of market cap of the S&P 500. Wow. So for the large cap index specifically, this group is impossible to ignore.
Gina, I want to pull out that book you and I loved, White, Sandy, Fried, and Ben, page 842. They talk about FX adjustment. My amateur take is 2 to 3%, multinational. There's a, who cares? It's noise. We're clearly not in a noise aspect. That 2 to 3% FX headwind, what's the new number?
Yeah, it's going to be a really interesting earnings season. Usually we get about 30% of companies on the index are actually exposed to currency because those are the biggest multinational companies. They're the ones that actually sell overseas. The companies most exposed to Europe and China in particular are the companies to watch. That's about 17% of sales on the index. But the degree to which the currency has moved would suggest that these companies are going to experience some degree of pretty extreme currency pressure, provided they weren't hedged coming into the season. Now, I think what's interesting about this is going into second quarter, remember we had the same phenomenon. The dollar was absolutely surging into second quarter earnings. We did see the multinationals generally underperform. Note currency as an underperformance factor. It had almost no net impact on the stocks. So will it impact the stocks is a very different question than will it impact the earnings stream. We think it definitely will impact the earnings stream. At this point in the cycle, every 1% gain in the dollar is worth about 17 bips on earnings growth. So we do have an impact overall, but will it impact the stocks or is it in the stocks is the key question for investors.
Hey, Gina, wonderful, as always. Gina Martin Adams there of Bloomberg Intelligence responding to the earnings we've had so far. Looking ahead to the earnings still to come. Next week is just a massive week. Next Thursday, Apple and Amazon after the close, and Tom, the same day, earlier that morning, we get the ECB decision in the mix as well. So busy morning next Thursday, October 27th.
October 27th.
I've never been a big fan of bank earnings season. I'm all about the big tech players next week. Much more interested.
Well,
in that.
Gina just mentioned that. I mean, the percent of capitalization, the percent of the market, the percent of the Dow Jones Industrial
Of
Average
course,
is
the Dow. It's very, very important.
Very
I'll
important.
change the subject quickly.
Please.
I was busy
very good.
reading a YouGov poll, and the headline reads as follows, Tom. Most Tory members say Liz Truss should resign. Surprise, surprise. The next line says Boris Johnson is the most popular successor of the Conservative Party members. That poll just out
And
from
I mentioned
YouGov
this yesterday. That's
this
what
hour.
Churchill did. Churchill would die and come back, right? Die and come back.
You reckon he might come back?
I'm unqualified.
Not Churchill. Not Churchill.
No.
Boris.
I could argue that Churchill is not making a comeback.
Coming up in the next hour, Jerome Schneider will be with us, the managing director over at
You
PIMCO.
helped.
Live from New York City this morning. Good morning. Equities doing better than good and Goldman doing okay. Equity futures advancing from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Slogans attacking President Xi Jinping featured on banners on a Beijing bridge last week have spread to other cities in China, as well as across the globe. Phrases from the original handwritten banners have criticized strict lockdowns and restrictions that have defined Xi's COVID-19 zero policy and called for new elections. German Chancellor Olaf Scholz has ordered an extension of the lives of the country's three remaining nuclear plants until April 2023. And that decision is meant to end a standoff between two coalition partners. The Greens are opposed to nuclear power, but the Free Democrats argue Germany should use all of the generation capacity available to tackle the energy crisis. Chip delivery time shrank by 4 days in September, the biggest drop in years. It's a sign that the industry's supply crunch is easing. Lead times, the gap between when a chip is ordered and when it's delivered, averaged 26.3 weeks in the period, according to Susquehanna Financial Group, down from nearly 27 weeks the prior month. Women in leadership roles are quitting at a faster rate than ever. A new report from McKinsey & Company and leanin.org, it shows that for every woman at the director level who gets promoted, 2 female directors are choosing to leave. A lack of advancement opportunities, flexibility, or unequal treatment are to blame. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
The Fed is on a mission. This is a very intentional and aggressive tightening of domestic monetary conditions in an effort to slow growth, slow demand, specifically loosen up the labor market a little bit to get inflation back to target. So definitionally, there are going to be some things that probably break along the way.
The brilliant Bob Miller there, the head of America's fundamental fixed income over at BlackRock, live from New York City this morning. Good morning to you all. Equities pushing higher again on the S&P 500, pushing higher by 1.9% on the S&P, up by 69 points. Treasury yields moving the other way. We're down a basis point to 399.63, call it 399.40 on a 10-year right now in the FX market. Euro not doing much, a bit weaker going into the ECB next week. We're negative 0.1% on euro dollar, 98.33, and crude up 0.1, 85.55. As we reported overnight, Tom, that we could get another SPR release from this White House, maybe getting that announcement later this week. And can we just tally up things so far? We've had 180 million barrels released from the SPR.
It's just different than my youth. I mean, I guess Bill Clinton was the first one to get out here with the experiment of a release, and this is very, very different. Granted, a war in Ukraine, but I'm going to barbell it, John, $86 on American oil, $92 on Brent crude. And obviously, you mentioned this earlier, it's the election, but
sure,
are those elevated prices? I don't know rhetorically.
The question I'm asking is how vulnerable are we to the whims of OPEC Plus next year if we've drained the SPR? Is this a one-off shock that we get over early next year and we can move on from, in which case this is an appropriate use of the SPR to get over a short-term one-off shock to cover a flow issue? Or is it something bigger than that? And if you believe it's the latter, then we're exposed next year and a little bit more vulnerable, Tom, than we otherwise would be.
We will see. Right now on GDP, and of course, it's coming off the bang-up Goldman Sachs earnings and what we've seen. Futures up 70. The VIX really doesn't move yet, 30.85. We get a view on the economy with Stephen Risciuto, Chief U.S. Economist at Mizuho. The tag team of Risciuto and Constam, outstanding at Mizuho. Steve Risciuto, I want to talk about the hope and prayer that inflation will come in. We're beginning to see glimmers of goods inflation coming down off of all the pandemic gyrations. Do you model that goods inflation can get back to a strong disinflation, or dare I say deflation?
Well, really good question. I think the answer to that is after we get through this cycle, there is a reality that is going to settle in that the world still exists in excess supply. And that, in fact, through the diversification of supply chains, we've probably amplified that excess supply, especially against the backdrop of global decelerations in growth that are likely to be sustainable, not just in the U.S., not just in Europe, but also in China. And the net result is, since we haven't destroyed the capacity as a result of the COVID shock and the latest inflation and the results of that, we're going to be sitting with too much capacity at some point in time, and that will drive down good prices and will lead to a deflationary bias down the pipeline. But the key, I think, for you is this going to lead to near zero interest rates again? And the answer is probably not.
Doug in Florida grilled to the New York Yankees this afternoon, 4 p.m. He emails in and says, ask Risciuto about housing. How does housing fold into service and goods inflation?
Well, I mean, housing is a critical part of it. It's one of the most interest rate sensitive sectors of the economy. The automobile space is the other side that's very, very interest rate sensitive. And we're seeing problems developing in both of those spaces. And yes, as demand gets pulled back, those are big ticket items. Those are items that get reflected very, very quickly in terms of the chains of production. And I think those are part and parcel of what we're experiencing in terms of the downward draft that we're already getting in terms of goods inflation. We're still struggling with the service inflation component of this, however.
Steve, you said something that I want you to elaborate on, that we're probably not going back to 0% interest rates again in the near future. What is the baseline interest rate that you see as where we end up once we're out of this inflationary and then disinflationary period?
Yeah, I think it's around 2%. I think it's consistent with the underlying trend rate of growth in the economy as to where real short-term interest rates have to be. The near-zero interest rate environments occurred in an environment where we had systemic credit issues that had to be corrected in the economy, and therefore you needed to create abnormally low levels of interest rates to correct that problem. In this environment, we don't see those structural credit issues. There are going to be companies that go bankrupt. There are going to be financial institutions that have problems in here. But if you go back to areas like 1975, where we didn't have systemic credit problems really dominating the business cycle, we had upwards of 140 financial institutions that needed to be resolved and 2 insurance companies that needed to be assumed by other insurance companies. And we didn't have a systemic credit risk. So there are going to be, casualties as a result of this, but they're not going to lead to a systemic credit crunch environment.
The casualties, Steve, how much is that going to be the fiscal programs of a lot of developed markets? How much are you going to see a massive program to reduce debt in the developed world?
Well, there is no doubt that there's a lot of debt that has been accumulated, but also keep in mind, for most of these governments, including our own, a lot of the debt has now been internalized by central banks, and therefore, in our case in particular, all that interest expense gets credited back to the U.S. Treasury, and therefore is pretty much of a net wash. I don't think we're going to really reduce the debt as much as we are going to allow the economy to grow around the debt, which means we're not going to be able to go through expansive fiscal policy programs for quite some period of time without having it being reflected in long-term interest rates.
Hey, Steve, you're one of the best. It's always great to hear from you. Steve Risciuto there of Mizuho on the latest. Did you see the Mohamed El-Erian tweet yesterday? It got a ton of feedback. This one was fascinating. Here it is for you. An independent Federal Reserve is critical to the well-being of the US economy. Having said that, it is getting harder to justify such independence when 4 big operational errors of analysis, forecasts, actions and communication are accompanied by a lack of accountability. Lisa, your thoughts?
Well, first, to just clarify, it does not seem like he is, and his clarification saying that the Fed should not be independent. But the issue is, how much credibility has the Fed lost, and how do they need to regain it in order to protect themselves against losing said independence because of the faith that they have lost in some of these errors? It's a massive issue, and you're seeing this certainly with the political sphere, and you're going to hear that with more Elizabeth Warren discussions around what they're doing.
And Sanders too, without a doubt. Tom, I messaged Mohammed last night about this. Effectively, what he's trying to communicate here is that the errors that have been made have invited criticism and pushback around the central bank's independence.
I take real issue with this. I think Ambrose Evans Pritchard, who Mohammed and I know well, did a tour de force in the Telegraph on this. The traditional theory and the construct of it, including the Phillips curve, and as the laureate Krugman mentions, the Beveridge curve, they don't work in a pandemic-adjusted regime shift, to use Bullard's phrase. And with that, they're flying blind every moment. They've made mistakes, no question about that, but it's not within a normal, theoretically founded structure. It's original. They're allowed to make mistakes.
To Lisa's point, Senator Sanders, Senator Warren, this is all just getting going. This is the beginning. It's not the end of any of this. When you start to see unemployment go the other way and the Fed comes out and says, yeah, this is the objective, we've got a problem.
And this is going to be an even bigger discussion when you go to the point that we were just talking about, where you have basically monetized fiscal budgets, and that's something else that's an issue.
Equity futures up 1.8% on the S&P. Live from New York, this is Bloomberg.
The Fed is still the central focus. And when it comes to the dollar, there's a lot of concern.
Clearly, inflation is becoming more entrenched.
I think it's in February and March. That's the sort of timing I have for dollar weakness to come back in.
The Fed is on a mission. This is a very intentional and aggressive tightening of domestic monetary conditions.
This is a long, drawn-out, multi-quarter economic downturn, not something that's going to reverse quickly.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene on radio, on television. Jamie says business is okay. Brian says business is okay. David says business is okay. John, there's a theme here.
And don't forget Jane. Jane says the U.S. economy remains relatively resilient. So every single chief on Wall Street is basically telling you the same thing. 3Q is okay. Business is doing okay.
And we saw this the last quarter as well. And the one is, I guess, as Bramo says, it's the view forward in the conference call, and we'll have to see what they say.
The view forward is uncertain. It is uncertain. And if you want to get bullish, the ultimate lows, according to Bank of America and Mr. Hartnett, front half of 2023. No cuts, no party. Seems to be the story.
Everybody just in. We look at equities, bonds, currencies, commodities. We'll do that in a minute here. A fairly quiet day. But, John, not quite in the United Kingdom. Continued volatility for Governor Bailey.
I mean, I can't keep up. So the FT came out overnight and suggested this Bank of England was ready to delay QT. Then the Bank of England came out several hours later and said that report was inaccurate. So, Tom, you decide. And sterling in between has been absolutely whipsawed. The Prime Minister's just about hanging on. We've had basically the budget. You'll get the full budget at the end of the month. And the Bank of England's going to make a decision in early November to hike interest rates, Tom, maybe by 75 basis points, perhaps even more.
Lisa, you featured earnings earlier in the brief, and to me it's the arc of the elites doing really well and a whole bunch of other people really struggling here within the UK, the US, and frankly the global economy as well. It looks like it's two global economies.
Which is the reason why it's going to be even more political as the Fed continues to tighten rates in response to the inflation and the persistence that you're seeing, particularly with people who do have more money that are spending it. And we talk about how it's an uncertain road forward. The earnings have been looking good. And so right now you're having a 4.93% Fed funds rate being priced into the market as of March 2022. What does that do to the economy? 2023. Yeah, I lose track of these years.
But still, that's on the edge of 5%. And, John, we're not framing that.
Look at this rally. 1.8% on the S&P 500. We had a monster move yesterday, and we're adding to it. Bear market rally. I think that's what many people are calling it. Mike Wilson and Morgan Stanley expected it.
Okay, Wilson's been very good on this, and some of the bulls are adjusting. We'll get to that in a moment. Andrew Sheets with us in a moment. John, let's start the data. I'm going to go to yen, which is in, I guess, intervention territory, 149.13 on the edge of 150.
Kick it off with equities. Get the board up. Equities absolutely flying. We're flying here again, up by 1.9% on the S&P 500. Futures up 69. Yields not doing much, in and around 4% on a US 10-year. At the front end of the curve, through 450 last week. And the conversation we've got to have: how much scope is there for more upside on pricing this Fed terminal rate? You said we're close to 5 right now. How much further are we willing to push this?
But that's not the issue, right, that people are talking about, particularly Peter Scheer. He's talking about what's the weakness that would have to be seen for them to pull back from this, and how is that going to be priced? And I almost got the sense that once we treat bad news as bad news, that possibly is when we start to get the capitulation that everyone's been looking for the next cycle to start.
Just the Bramwell concept.
Well, what do you make of how we're treating the data so far? We had that monster upside surprise on CPI. And then we rallied really, really hard, and we're doing the same thing again this week.
Dow futures up 500 points just to get your attention.
Thanks,
The
Tom.
Bloomberg Financial Conditions Index, 1.5 to 1.2. It's less restrictive. And this morning, Andrew Sheets knows that. He's Chief Cross Asset Strategist at Morgan Stanley and joins us. It's going to be an amazing set of meetings, Andrew, at Morgan Stanley today to recalibrate into November. Take the jumble and make sense of it. How do you recalibrate to the end of the year?
Well, thanks, and it's really nice to be here with you guys. So look, I think you have an overlap of a tactical story with a bigger strategic story. Tactically, as you heard my colleague Mike Wilson turn tactically bullish on the S&P as of Sunday night. He sees the potential for a rally to 4,000. A number of the tactical indicators that we follow do suggest a market where sentiment's pretty negative. Things look oversold. Maybe actually earnings season, after a lot of negative guidance, turns out okay, and you're into a window where seasonality for risk assets is often somewhat better. But big picture, we still have growth that's going to be slowing over the next 3 to 6 months. We still have a lot of monetary policy tightening ahead of us, even if markets don't price anything in additional above what's already expected. So, and you still have earnings that we think in the U.S. and Europe will need to be revised down, in the fourth quarter or the first quarter next year. So I think the way to think about this is a bear market rally. It's short, it's sharp, it still matters, but the big picture hasn't changed, and there's still work to be done, I think, before we can say this bear market's over.
Andrew, to Lisa's point, we've priced in a big rate hiking cycle. Maybe we haven't started to price in the consequences just yet. What do you think the consequences will be, and can we put some numbers on it? I hear this short, shallow nonsense all the time. I have no idea what it actually means. Andrew, what do you think it means?
Well, I think it means that you could see a downturn that matters a lot more to earnings than it does to GDP. That we've been through an environment where goods consumption has soared relative to services consumption, the type of economy where kind of everybody buys a barbecue and nobody goes to the dentist, so to speak. And that's a type of environment that is generally good for earnings. The S&P 500 global equities are really good at monetizing goods and turning them into earnings. They're a lot less good at monetizing services and turning those into earnings. So I think you could have an environment, if you look at those consumption series, where goods demand comes down, services demand holds up pretty well. The overall GDP effect is pretty modest, but ultimately the earnings impact is larger. And to be more specific, housing is so important to goods demand. Think of it, every time somebody moves, people buy furniture, they buy electronic goods. There's a lot of stuff that gets bought in a housing transaction, and yet given this move in rates, we're seeing housing transaction volume really decline, to some of the sharpest deceleration we've ever seen.
How much are long-dated bonds the best haven right now if people are starting to think that perhaps we're pricing in peak Fed, we're pricing in a Fed that gets as aggressive as we've seen for decades?
Well, I do think you've seen more value come back into the long end of the market, but again, I think you also have some challenges there where you're dealing with a pretty high vol asset class, and I think there's some really legitimate uncertainties around where kind of new neutral rates are going to be, and also where, what is the type of kind of real interest rate that's required to slow the economy. And I think we still kind of don't really know that. And I think there's a genuinely large cloud of uncertainty out there. So I think it's probably still a little bit too early to kind of go into the very long end of the curve. But, one asset class that we think has a good kind of risk reward combination here would be something like 1 to 5 year corporate bonds in the U.S. They yield about 5.5%. That's not that far away from the earnings yield of the S&P 500. And as an asset class that we think can still provide, some pretty decent income, above what we think inflation is over the next 12 months, while still providing some ballast and less volatility than other things.
Andrew, just one final question. The number that jumped out for me in your latest report, Mike Wilson's from over the weekend, was just how far you think this bear market rally can go. Something like 4,100. Now, Andrew, that's a big monster move higher. And Andrew, I wonder, when you look at that, at what point would you look at it and say, oh, maybe we're not right about this. Maybe this is more than just a bear market rally. What would tell you?
Sure. So I do think the inflation numbers are very important. If we see positive surprises to inflation, there is a lot of good that can come from that, right? Then the market can start to think maybe the Fed doesn't need to do so much. Maybe we can start to see the Fed backing off, and that relieves pressure from rates, which can swing back into equities. I think seeing labor force participation continue to climb, that would be quite good, suggesting the supply side of the economy is stronger, that we can have more growth for a lower level of inflation. And then on the earnings front, a reason why we've been cautious has been around the view that margins will come down ultimately, and earnings estimates will come down. Maybe the inventory problem is better than we expect. Maybe companies are able to defend margins through cost cuts that don't impact the broader economy to such a negative extent. And I think that's where the bull case lies.
Okay, Andrew, you and the team have just been absolutely awesome this year. Appreciate it, as always. Andrew Sheets there of Morgan Stanley. Appreciated what Andrew had to say there. Drew a distinction between GDP, short and shallow, and earnings, maybe not short and shallow. Tom, there's a difference.
Well, there is, and I'm going to go back to this on the revenue dynamic and down the income statement. You can choose it, and it's different sector to sector what happens on the income statement, but they're going to adapt, as Mr. Sheets talked about at the end there. It's going to be one part pricing power, which we all know, and it's going to be one part cost cutting. And you know what? They're going to get to the other side.
Drew Madison MetLife writes in on the Bloomberg. Lisa, he says short and sharp, not shallow. That's the pushback.
Yeah.
Get a lot of.
Well, and this is sort of the economic play, but just going to what you're talking about with earnings, how much, going back to what Steve Rasciuto said, do we have to reset corporate performance and the earnings in a 2% Fed funds world? If that's where we're heading back to, it's not a 0%, it's 2%. How much do you take away from the momentum of the financialized world and potentially give back to the real economy?
BofA's fund manager survey today, the theme of it was capitulation. And if we can push that just one step further and build on what you just said, I don't think people have capitulated at all on the view about where we go after all of this. The destination. The destination for so many people still is to go back to the pre-pandemic playbook of low rates, low growth, low inflation. And Tom, that's a view that we have not capitulated on.
This is how far down we are, and to your point, and I agree on capitulation. I'm not going to use Dow points up 523. I'm going to look at SPX up 73, 3,700 rounded up 3,800. 2 standard deviations. You don't even get through resistance until 38.42. We're still distant.
How many times are you going to squeeze Dow points into this segment?
That's what America cares about. We look at Dow points and we know we're distant from 36,000.
You're going to keep this up, aren't you?
Yes.
I can tell you're in the mood for it.
It is.
Coming up, Michael Nathanson, founding partner and senior research analyst at Moffett-Nathanson. I noticed that in the weekend. I almost cancelled my journal subscription again.
That's what we do.
What, Dow points?
Yep, Anaconda Copper. Westinghouse.
What year is this?
Oh, 1940.
This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Just 10% of Britons have a favorable opinion of their Prime Minister Liz Truss. That's according to a YouGov survey. Now, the results come one day after Truss was forced to pull back on the bulk of her economic vision for Britain. Some 80% said they had a negative view of Truss, giving her a net favorability rating of -70. Russian missile and drone strikes targeting Ukrainian power infrastructure over the past week have failed to knock electricity supply off the grid for any prolonged period. That's according to the International Energy Agency. Now, hundreds of recent strikes have targeted power plants and electricity substations across the country. The Biden administration is moving forward, releasing at least another 10 to 15 million barrels of oil from the nation's emergency stockpile. The move is said to be meant to balance markets and keep gas prices from climbing even further. The Strategic Petroleum Reserve release would be the latest in a 180 million barrel program that began in the spring. AT&T is counting on stimulus dollars to help fund its broadband push. The wireless giant wants small towns to use federal economic recovery money to cover the cost of landline high-speed internet to rural and remote areas. CEO John Stankey met with local politicians and residents in Indiana about using American Rescue Plan money to cover a portion of its fiber network expansion. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
The old system of stimulating your way out of any kind of recession or financial market pain isn't being allowed. You're in this scenario where you're going to have a slowdown, you're going to have pressure, you're going to have credit cracks, and the federal government and central banks can't come to the rescue as quickly.
Love Steve Cheverone, always great, the head of multi-asset solutions at Federated, joining us just yesterday from New York City this morning. Good morning. Equity markets pushing higher, Goldman numbers doing okay, futures up by more than 2% now on the S&P 500. This is a really big lift going into the cash open off the back of a really big day of gains yesterday. Yields are lower by 3 or 4 basis points. We're down 3 to 397.98 on a 10-year. Goldman behind us, Tom. Netflix still ahead. Those numbers after the close. That stock is down by 59%
well, they're
year
going
to
to be
date.
bailed out. They're going to have the conference call, and they're going to talk about the new Hollywood property they've got at Netflix called Dead Cat Bounce, and we'll see how that goes. Maybe that'll be like the Queen's Gambit. We need to get an update on entertainment. Always, we can do this with Craig Moffett and Michael Nathanson of Moffett-Nathanson, a division of SVB, and we're thrilled that the well-coiffed Nathanson could join us this morning. Michael, I'm going to digress here to when the thud you heard was me falling off my chair. Is Mr. Murdoch wants to piece Humpty Dumpty back together again. What did you think when you saw young Murdoch said, let's bring it back together again?
Yeah, that was not the playbook we wanted to see. We have a buy on Fox. Robert Fishman covers it. Our view on Fox is it's a pure play on sports and news, which we think is the glue to the bundle. And they're not wasting their money fighting streaming wars, right, Tom? It's a very clean story. We thought at some point they would sell Fox to private equity or another media company. So here, I think what the narrative is from here is the company is going to need approval from the majority of the minorities, and I don't think that's coming because I think the clients we talk to who own Fox are not happy with this decision. And we'll see what comes next. There's probably a second leg of the story, right? They'll put them together and then do something with those assets, which we're waiting to hear more from the Murdochs of what's their intention after they combine these two companies.
Just because of the calendar, I've got to go to Netflix. They're teetering on 3 legs. Some would even say a 2-legged table as well. What will you listen for from Netflix today?
Okay, so they're introducing an advertising tier for $6.99 in the fourth quarter. What I want to hear is why are they so confident that there won't be a spin down, as they say in the UK, from a higher price point down to this new tier, which would be very dilutive in the near term for revenue per users. So I like to hear why they're so confident that this will not be in the near term a very dilutive strategy, right? That's to us, given their dropping price, and as we talked earlier, they don't have the same grip on users as they once did. I think there's a risk that there's a spin down here.
Michael, how much are you looking at the potential for some of these media darlings, the online streaming services, certainly during the pandemic at least, being acquired by the likes of Walmart, being acquired by the likes of Apple? And this has been something increasingly rumored about.
Yeah. The challenge we have is some of these companies are family held. Tom mentioned the Murdochs. The Redstones control Paramount Global. NBCU is controlled by the Roberts family. There has to be capitulation, which we don't see yet, right? Everyone thinks they have the right strategy of bleeding linear and investing in streaming. At some point, we think in the next 12 months, 24 months, there will be capitulation. The companies will realize that they have the wrong strategy. They don't have the balance sheet to make this pivot. They're undersized. And maybe there'll be some M&A, but that's not our working thesis right now, right? There has to be some level of realization that these strategies are just not going to work, right? Like you have 4 or 5 large players in streaming with much better positions. So the people who are lagging have to get out. And I'm not sure they're ready to do that right now.
So who do you think the ones that need to get out actually are?
Well, you would say that Peacock, Paramount, there has to be some combination. That'd be Comcast and Paramount Global. That they've done well within the US, but they're not going to scale to that higher level with a profitable business model. They're going to need to find some way to combine streaming assets. We'll see what happens to Warner's, WBD.
Yeah.
Like the market is really worried about the debt load there. There's a true asset value of that company, but the debt load is scaring people away. So you would say that those 3 companies need to figure out some path forward, maybe consolidation to get some more scale.
Michael, do you think that Disney's making the cable package, the cable bundle all over again with Hulu? Is that where that's going?
They're trying to, right? So they have Disney Plus, Hulu and ESPN Plus. John, our concern is the cable bundle is the best product we've ever seen from an economic standpoint, right? Everyone's paying the same amount of money. No one's watching the same amount of channels. You have to be very, very careful not to further disrupt that bundle. I think Disney thinks long-term, we have the goods that we can replicate the product, but the economics of that new offering are going to be so below the economics of what we're coming from. So I think you have to be really, really careful, but they have the pieces in place. I'm just hoping that the speed to change is slower by them than maybe what they want to do.
Michael, we didn't have you on for all this chit-chat. Yankees, Cleveland, cut to the chase.
Well, Tom, the guy behind me, I wish he was pitching tonight, right, or today. I'm worried about the bullpen as everyone is, right? It's not the bullpen of number 42 behind me.
You satisfied with that response?
I am. On radio, it was great.
Okay, good.
Mr. Rivera behind.
Just to clarify.
Mr. Nathanson as well. Just to point out.
Michael, thank you. Michael Nathanson of Moffett-Nathanson, an SVP securities company.
Yeah, you got to go with the Yankees. I mean, this is great, and
Can you? Whoa! Can you just repeat what you just said?
You got to go with the Yankees.
Okay,
I'm sorry.
done.
I mean, Dodgers tank, Mets.
That was just for Doug Cass at home.
Tank. And the fact is, you got to keep the Yankees in there. So, and Yankees Houston, frankly, is going to be.
You're saying it's good for commercial reasons.
No, it's just good for baseball. I love the small game. The small game, John, is like bunting, scratch singles, fast guys. I love that much more than the home run.
We call that rounders in the UK.
Rounders, yeah.
No, that's not what you call it. No, okay, he's insulting baseball.
No, I'm not at all. Have you played rounders before?
No, but I've looked it up after.
Rounders is an epic game.
That's played by school children.
Sure.
Which is not played in any sort of major league.
It's a fantastic game.
I just do want to just say that
one-handed with a bat, Tom. Really intense stuff. Really intense stuff.
You're not insulting.
Yeah, like hardcore. Like people take it very seriously at lunchtime.
I mean, I like the Clevelands. It's great, but it's going to be. It's fun. It's baseball. As Nathanson says with Fox, it's all about sports because that's all that's left.
We've getting fights about rounders at school. We just took it that seriously in the UK.
Really?
Yeah.
Well, I will guarantee that somebody is screaming at the screen right now because Tom said you have to go with the Yankees, and all the Mets fans out there are absolutely livid, just theoretically.
They were asleep,
What's happening with Judge? You coming in for him or not?
I mean, Steve Cohen and I have discussed this extensively.
Steve's watching. Ask him.
So please write in, Steve, and let us know if you're gonna do it.
Okay.
Then
right.
This is special.
Jerome Schneider's coming up shortly from PIMCO. Got a lot to talk about.
There's
in the bond
a lot
market.
to talk about here.
Do you think he's been a busy man this year?
Meetings.
Do you think that guy's been a busy man this year? Short interest rates.
Yeah.
Short-term portfolios at PIMCO. I imagine there's some serious money flowing into that.
And let's be clear, PIMCO nailed the get out of long-term debt call.
Jerome Schneider at PIMCO coming right up, live from New York City. This is Bloomberg. This week, what a run. Monday morning, off to the races. Tuesday morning, off to the races. People deploying some cash, TK. Equity futures right now up 2% on the S&P 500. Adding to yesterday's gains. Yields are lower by 3 basis points. Your 10-year, 397.57 in the FX market. I don't know what those hand signals are.
98.
45.
We're getting your Dow up
We're back in the
600
pits
points.
again.
It's fine.
It's
Come
just
on.
sort of like gesturing to me. How much
You're
you
not
buying?
having a food fight on Twitter on the Dow.
Crude 85.52. People get so angry on
They do.
Twitter.
It's
It
un-American.
really makes me laugh. You know, telling me that, what was this individual telling me that, I can read it out loud for you if you want, Tom. Please dispense with your silly trash talk of the Dow not being
There you
representative of US stocks, Apple, Microsoft, Goldman. It's not about the members. It's about how the members are weighted. That's all. And for the people that complain about this, are you allocated to the Dow passively? Yes or no?
Someone today said that
Probably not.
Character of the country, and
I get
the
it.
fact is you do both.
I get
and you do
it.
NASDAQ 100, not NASDAQ Composite.
I get it. I'm on board. You can do it.
You're on
By
board?
all means.
Well,
you
we're
can
getting
say
up near
it.
31,000. What was not broken is the VIX. The VIX 30.72 has not come in, given the enthusiasm of the
They're like you,
moment.
just angry on Twitter. Why is everyone so angry on Twitter?
Twitter, somebody said that I'm wearing a Snuggie today. So
What is that, a Snuggie?
They said that to me too.
Let's move on. Yeah, it's
What
like
about-
a
what's
nice
going on
thing.
right
You know,
now?
it's like
That's
a kind of huggy thing.
ridiculous. Ignore it.
It's okay. I wish I were wearing a Snuggie.
Elon's going to clean this up. He's going to
Okay,
take
yeah,
care of
right.
this.
Okay.
Let's see.
Let us continue right now, and we do so and celebrate the holiday season. We begin Thanksgiving with Jerome Schneider, Managing Director, Head of Short-Term Portfolio Management, an advisor on Thanksgiving dinner at PIMCO, and here on Bloomberg Surveillance as well. How's your year been? Short-term paper is a place to hide, right?
It's busy. It's quite busy, and absolutely, short-term paper is a place to hide. I think the nuances of short-term paper really are what the story is about for 2022 and actually 2023. Folks, as you've highlighted before, is cash is not necessarily as democratic as people would like to think. And while cash is king, the crown jewel of how you want to think about it is really more nuanced than that. Yes, bank deposits are, in some cases, slowly moving higher. T-bills may offer some attraction, but the reality is they're trading actually quite rich, in some cases 30 to 50 basis points through benchmark rates, meaning what the Fed is expected to be at. So there is other value if you actually want to be more appropriately highlighting and thinking where interest rates should be headed based upon Fed expectations.
In the PIMCO meeting that you have out there, the 10 a.m. meeting, whatever the legendary meeting is, what do you say about the short-term space and dollar illiquidity worldwide? There was no other theme at IMF.
Well, there's a reality of what we're thinking about is that we are facing a change where people need to digest the changing cost of capital. And the notion of liquidity is one that has been more prolific. People are concerned about liquidity. It's been sort of a call word, if you will. But it means very different things to very different people. And I think that's the consequence of when we want to think about the marketplace. You have macroeconomic liquidity. You have liquidity concerns driven to quantitative tightening. You have haircut concerns and margin requirement concerns, which we've clearly seen within England. And more importantly, as the economy progresses to more of a state of concerns about growth, then we're going to see other tightening ratchets of illiquidity and haircuts. Those are the liquidity facets we really need to be paying attention to. So from a starting place at PIMCO and everybody else, we have relatively judicious high amounts of liquidity, preventative liquidity, defensive liquidity. But the key then comes into how do you use it? How do you think about it opportunistically, given the uncertain outcome, given the growth environment, given the slow GDP, but perhaps shallow but longer recession that we think at PIMCO? And then ultimately, how do we then extrapolate that to value in the future? So it's all about really how does liquidity translate to volatility within the marketplace, and how do investors absorb that volatility properly?
The problem for a lot of people in the market right now, Jerome, as you know, is when you expect there to be liquidity in an asset class where there should be liquidity, and then there is not.
Right.
Can you talk to us about what's happening in the Treasury market? We know that last week the Treasury reached out to a group of individuals. The Treasury has this connection with a group of individuals in the market they speak to. They try and get feedback about what's going on. One thing they asked about was whether they should buy back certain securities to improve the liquidity and the functioning of the market. What do you say back to that?
Yeah, John, this has actually been top of mind, not just simply over the past few months. And we published a paper at PIMCO sort of highlighting this, suggesting some all-to-all trading, and actually elicited some pretty positive, constructive dialogue within the marketplace. That's a function aspect of where we want to think about where the market and how the market is digesting actual functional high quality assets. It is a concern, but it's also an opportunity for investors. Those investors, they can really think about how to maneuver around these higher cost of capital and, more importantly, the opportunity sets because of the wider bid offers. So what I would suggest is, yes, It's a transformation from what we've been used to over the past 1 to 2 decades. And it is a concern when you think about some of the curtailments that you have from a regulatory and sort of a functional framework. But as an active manager, you're going to incorporate it and find opportunities to incorporate it. And it just might simply mean that, yes, there's more volatility, but you're going to have to be more convicted and have longer holding periods.
So there are two different things here. There's one about the Treasury possibly buying back debt, and then there's investors acting as liquidity providers and stepping in the all-to-all and disintermediating banks. Is that what you're saying, that if the banks were not necessarily the ones that were there and you had a platform where you could really make markets in real time, that would possibly be a more effective way of providing liquidity to this market?
Well, I think liquidity in general isn't necessarily a democratic process. And so when you think about it, there's different layers of liquidity within the marketplace. And we're suggesting is you have more degrees of freedom, then maybe perhaps that's better for the market liquidity as you go forward. It doesn't necessarily mean that people have a view or a more constructive view or a less constructive view of where the market is headed. The market is the market. But when we think about it, that broader based landscape is where we're really trying to head in that regard.
Meanwhile, the Bank of America Fund Manager survey showed that investors are holding the highest cash piles going back to 2001. And we hear that from everyone. You know, cash is your friend. You want to be liquid. You want to be nimble. Is your experience that it's just flooding in, that people are coming to you and basically just saying, please give us anything you can to give us a sense of what our income could be, how to be safe, and you're sort of overwhelmed, or is it not really the case?
You know what the problem is, Lisa, is that people are focused on looking and driving in the rearview mirror. And the reality is that as you're thinking about where it is to come, they're so focused on what has happened in the past 1 to 2 quarters, they don't necessarily have the ability to look out the front window and see the opportunity set that perhaps that cash and, more importantly, fixed income provides in this landscape. One of the concerns that you have is obviously growth. One of the concerns you have is sort of, does the risk parity element of having interest rate exposure duration offset some credit risk taking and broader risk taking within equity markets? And maybe those correlations don't hold at this moment. But if they do reemerge, then there's some different opportunity sets. And the higher rate environment we're finding in right now is actually the setting of the table of something that is very different than we had for the past few years and decade.
Let's build on that, you're right.
So don't keep looking in the rearview mirror ultimately.
In that rearview mirror is not just 2 quarters, it's a decade's worth of zero rates, negative rates, QE. When I hear you talking, I get the sense that you think this is something that's going to hang around. Not just 1 year, 12 months, that this is something we need to adjust to.
It's going to be unlikely that we get back to a zero rate level for, on a flat yield curve like we've been witnessing. As a 2-year note at 25 basis points seems to be something that's out in the past. But what I do think is going to happen is that when you see where we are, at least for the next 1 to 2 years, a higher inflationary print, when you have PCE that might level out at about 3.5% instead of closer to 2%, that means front-end rates are probably going to be in this vicinity for some period of time, and investors should get comfortable with that in that notion. Obviously, it has onset effects of what happens with equity markets, risk-taking, and things like that. But fundamentally, this is a higher rate level, and investors need to think about the value of fixed income in this environment, not just because of higher rates, but because of its complementary effects to total portfolio allocations.
Well, that's where I wanted to go. To short-term guy, let's go wicked long-term. Does the actuarial assumption shift? We've been going from 8% to 6%. Good news in terms of cash imputed into plans. Are we going the other way now, where we're going to have a higher actuarial assumption of our retirement plans?
Yeah, Tom. Ultimately, investors are going to look for different sources of how to produce total return. What we've focused on is declining interest rates happened over the previous 3 decades with simply that lower rates spurred on higher capital appreciation opportunities. That calculus has fundamentally changed. And so the total return composition is not just on capital appreciation, it's on the ability to carry and earn income, whether it's through dividend income or income from bonds in the traditional sense. And that is, quite honestly, one of the things that investors who are maybe new to the markets over the past decade or so need to be thinking about. So a lot of factors are putting us back into a more traditional 1970s, 80s, and early 90s mindset of not only how to trade markets from a liquidity perspective, but also how to think about constructing portfolios.
When was the last time we sat around a table together? Isn't this nice?
It's been a while. It's lovely.
It's good to see you.
Just more and more.
In town for the Yankees, TK?
No. Got plenty of client events.
It just so happens that the Yankees are playing that he's in town.
Total coincidence.
Okay, I'm sorry to accuse you for being in town for the Yankees.
No, I'm here to give turkey advice.
Of course. Jerome Schneider of PIMCO. Great to see you. TK, coming up in the next hour as we count you down to the Open. Just an all-star lineup for you. Kelsey Burrow of JP Morgan Asset Management. Greg Peters of PGIM. We'll catch up with Kate Moore of BlackRock around the opening bell as well. Looking forward to that lineup.
They're going to celebrate off the Thursday bottom up 2,170 Dow points. That's extraordinary.
Quite a rally, eh?
That's quite a rally. Yeah. That's how we look at it.
Do you want me to fill in the silence?
170 Dow points.
I'm going away for a few days after this.
Jerome was going back to Anaconda Company. Jerome was going back to Eastman Kodak.
Is that right?
Well, that's part of your total return.
What was the stock in Wall Street? What was that called? What was that stock called in Wall Street?
Can't remember.
Anaconda Steel.
There we go.
Anaconda
there we
Steel.
go. Sorry, good memory. Good memory.
Can I just point out something, just not to break this, but there is, we're talking about income. It was super special, but I just couldn't take it anymore. So Carnival offering yield of up to 11.5% on $1.25 billion of junk bonds. And to me, this is shocking and exactly to what Jerome was talking about, that basically you can get yield in a way that perhaps you couldn't as long as they don't go out of business. But there's a question of...
Exactly, that's the point.
Well, but that's the point. So, but how does that change, to your point, John, the sort of actuarial assumptions? I think that's fascinating. That's what I'm thinking about.
Couldn't take it anymore. Do you want to frame that?
I want
to frame that quote.
People should see what happens off camera.
I can't take it anymore.
What I would suggest,
Carry on,
Lisa,
Dow fights.
And I go to Taleb and Schneider here. The rules have changed. We're back to gravity. We're back to a risk-free rate, and it's something a huge body of people aren't familiar with.
I'm going to go. I'll see you next week.
Okay, good.
All right.
Quote the Dow in the 9 o'clock. It'll do you good.
Maybe once, just for you.
Just for me.
And you can do whatever you like for the next 3 days.
We'll call it,
All right.
Oh, you're gone?
Break some stuff. Do what you
Oh,
want.
my word.
Yeah.
Have a great time. We're going to miss you.
Thank you. You won't.
You going leaf peeping?
I'm going leaf peeping.
Good. Okay. That's great.
In Japan.
Oh, very good.
6 months early.
Right. What's it called again?
Momijigari.
You remembered it.
So remember it. I know it. I speak Japanese. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. French rail, energy, and other key workers are striking today to demand a bigger share of corporate profits. It's raising pressure on President Macron to take further steps to ease the impact of surging inflation. There's been protesting in the country, and commuters are facing travel disruption on trains and buses. Blockades at refineries and fuel depots have led to gas shortages. German Chancellor Olaf Scholz has ordered an extension of the lives of the country's 3 remaining nuclear plants until April 2023. The decision is meant to end a standoff between 2 coalition partners. The Greens are opposed to nuclear power, but the Free Democrats argue Germany should use all the generation capacity available to tackle the energy crisis. And the European Union is unveiling a new emergency package to tackle the energy issue, betting on steps to bolster solidarity among member states. But the bloc will refrain from immediate gas price caps amid political divisions and concerns over supply. Bloomberg has learned the European Commission was set to propose measures to avoid extreme price spikes in energy derivatives. Slogans attacking President Xi Jinping, featured on banners on a Beijing bridge last week, have spread to other cities in China, as well as across the globe. Phrases from the original handwritten banners have criticized strict lockdowns and restrictions that have defined Xi's COVID-19 zero policy and called for new elections. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
At the end of the day, if you want to attract investors, you need to have the right business model. And this review, in my mind, is all about clarity on the business model. This is what's been, in many ways, haunting the European banking sector for quite some time.
Philip Hildenbrand, he is a former leader of the Swiss National Bank and, of course, at BlackRock as vice chairman. I'll be honest, when he speaks, I take notes. He's that good talking there about European banking and the challenges forward. The smartest thing I heard on the show today was from one S. Bassick, who told me that Wells Fargo's price to book was larger than Goldman Sachs. I was stunned by that. Let's do the math. Wells Fargo off the Bloomberg screen. It's a little bit apples to oranges. Let's be careful. Wells Fargo 1.06. Goldman Sachs 0.98. Maybe that'll come up here with the good news once the market opens. And Credit Suisse 0.27. Lisa, the differential's stunning.
And this is the reason why the latest headline, the headlines just keep coming out. The latest one being that Credit Suisse is potentially speaking with Canadian and U.S. banks to raise capital after the October 27th restructuring plan comes out. So this has basically been this leaked process. Who's going to be the leader?
Right.
How are they going to raise cash? What are they going to sell? And it's happening in real time and being priced out by stock investors. And where is the faith right now?
Providing leadership for us in London here on this news is Michael Moore, who joins us with this Bloomberg story. Michael, from Jan-Henrik Forster, Denise Schneider, and Eck Henning, it's real simple. They're looking for capital. How soon will they find it? Is this today? Is it October? Or will it be a more protracted negotiation?
You know, it might depend on where the shares are and how they react to the strategy announcement. We think that this, if they decide to pull the trigger on this, it could come as soon as the strategy announcement in a little over a week's time. You know, when that would actually be placed is TBD. But, you know, ultimately, it seems like we have the rough outlines of their strategy, leaning more into wealth, shrinking down the investment bank, selling off pieces of that. And then it becomes a math question of how do you pay for it? And we've seen them pursue a number of asset sales. And then the other option, which doesn't look particularly palatable right now, but you have to put it on the table, is a capital hike.
Do we have any knowledge of whether they do a convertible offering or they give up equity down the road? Or will this be a Buffett-like preferred statistic of a big fat single-digit number return?
We've seen them do convertibles in the past. We've seen them do straight equity in the past. You know, the regulators have narrowed the definition of what counts in that core CET1 ratio that all the investors look at. So the options are somewhat limited if they want to boost that number. But that's kind of what investors are wondering is, you know, how painful would this one be?
Michael, what does Credit Suisse after this look like?
I think you have, you know, they have a strong Swiss business. They have a strong international wealth management business. And I think they're going to try to lean into that. A lot of the problems, but not all the problems, have come from the investment bank, and that's been losing money in recent quarters. So you've seen them with the SPG sales process try to sell off that unit, or at least pieces of it, and kind of shrink the capital that's devoted to the investment bank, a lot like UBS did a decade ago.
How much, Michael, is Credit Suisse an idiosyncratic story that's based on a series of events that have transpired over the past decade? And how much does it represent some of the struggles at a number of European banks that have resisted consolidation, that have resisted taking significant measures, like what we're seeing Credit Suisse speculate on?
I think you definitely, you know, see echoes in other situations. There have been a lot of parallels with what Deutsche Bank faced 5 or 6 years ago before they, you know, did a major restructuring. You are seeing, you know, you pointed out the price to book. That's definitely low, but it's you know, not unheard of in Europe. You see some of the other big European lenders trading around that 0.3 level. And so I think there are you know, other struggles across the board, but Credit Suisse is definitely the one in the spotlight right now because of some of the idiosyncratic issues.
Michael Moore, thank you so much. And that story just out on the Bloomberg terminal. We'll get it out on Bloomberg.com here in a bit, leading our coverage on European banks. It just never ends. And Lisa, I just absolutely don't understand to this day. And I remember at Davos years ago, a piercing conversation with David Rubenstein in a panel about the idea of in-a-nation mergers versus other nation mergers, like with Fortis Bank of Belgium years ago. And we're nowhere near neither of those right now.
Well, and part of this is because of stories like in Germany, everyone has their Bundesbank, and who's going to vote to have it sort of merged with somebody else, right? But how much is that a story around the European continent? On a broader level, we're seeing U.S. banks do really well. How much is that going to be sustainable, given some of the pushback saying you guys have to give more to savers, and the pushback at the same time that they come out and they say, well, our resilience is what's keeping us going and the reason why we haven't seen some sort of big explosion in markets.
The word I would do is festering here. Let's go to the stock market now with highs for the day. Futures up 85, 2.3%. Dow up a solid 633 points. Even the NASDAQ leads the way, 2.5%. It is well. It's off the bottom, but there's so much technical damage. I can't call technically through resistance.
I honestly am not getting that much of a signal from certain swings that we've seen in the stock market over the past couple of sessions. I am getting a consistent message from the bond market, which is that inflation is still prevalent and that you're going to see this Federal Reserve be able to raise rates much more aggressively than people previously thought. And as we heard Jerome Schneider, as we heard Steve Rasciuto say, where we end up is probably more likely to be a 2% level than a 0% level. That's different.
I haven't talked about it today, but on the yield curve, we come in negative 44 basis points, maybe a little bit better off the tension of last week. And the real yield was a positive 1.60. We give back a little bit there. It's a little bit, I use the Greenspan word, quiescent.
Yes, although consistent in where it's been. I mean, 1.5%, 1.6% for a real yield. This is a game changer for people who have been used to a valuation proposition in equities that is completely different. Yeah. And so the sort of stability of this contrasts with the whippiness that we've seen in stocks, and I'm getting more of a signal from bonds.
When is United Airlines? I said this like 2 hours ago. I said, I'm sorry, that's what's most interesting to me. I don't want to,
It's after the market.
It's after the market.
Yeah, it's after the market today.
I'm sorry, I'm really, really interested what the airlines do here. Somewhat like FedEx.
Well, we've seen
fascinating.
We've seen from Delta that they've done really well and that they actually outperformed.
We call it doing a Moynihan.
And that's basically as a result of business travel coming back, as a result of people using business class.
Every seat is taken.
And also people who have money have it to spend and they want to travel.
Yeah, but economy's packed.
Yeah.
Packed.
Yeah,
I mean,
are traveling.
I get the elite thing, but I'm sorry, it's a statement about the country, as we've heard from the banks. Congratulations to Goldman Sachs after all the gloom yesterday off of the restructure. Boom, pretty good earnings there. We'll see how they open as well. Futures up 84. Stay with us. On radio, on television, this is Bloomberg.